Um, Hello, everyone. Thank you very much for joining this webinar, which is on innovative finance for technological progress, roles of fintech financial instruments and institutions. My name is Farhad Taghizadeh from Tokai University, Japan, and it's a pleasure to co-host this event and moderate it today. First of all, I would like to express my thanks to our distinguished panelists, speakers, keynote speakers, and discussants for kindly accepting our invitation to join this event and contribute to this project, and also to our participants who are joining now. So today's event is a result of a call for chapters that we had jointly with between Tokai University, Iran National Innovation Fund, and Technology Studies Institute. So today, all contributors to these projects are gathering to present their research and to present result of their research. So output of this project is going to be published in a book by Routledge publisher. So I hope the comments that we all receive today help us to improve our work for preparing the final chapters. So let's start the webinar. First of all, I would like to invite Professor Naoto Yoshikawa, Vice Chancellor of Tokai University, for kindly giving the welcoming remarks. Professor, please.
Thank you. Good afternoon and good morning. Professor Yoshino, Dr. Mahamian, Dr. Malekifa, Dr. Abjafari, Dr. Taghizadeh, distinguished guests and colleagues. It gives me a great pleasure as a Vice Chancellor of the Tokai University to welcome you to this webinar today. Today's webinar also celebrates, just Dr. Taghizadeh mentioned, publication of innovative finance for technological progress, roles of fintech, financial instruments, and institutions. Innovative finance is one of the keys to venture capital for supporting the startup of small businesses. As mentioned in the statement of call for paper for this webinar, innovative business and startups play a significant role in job creation, economic growth, and technological progress in most countries. Many large enterprises in Japan today, such as Panasonic, Sony, Honda, Mazda, Sharp, and many others, were small businesses with difficulties accessing finance at the startup. Finance is a crucial constraint on the development of startups for small businesses. It is difficult for small businesses to access finance for their startup because they lack a business credit history and also they don't have assets. The lender cannot assess their risk without a credit history. Some small businesses in the early stage of the development may be facing a very high possibility of the failure and at the same time be just the next to great success. Conventional ways of financing are not sufficient for filling the finance gap of the startups for small businesses. Therefore, it is essential to look for innovative financing methods to access stable and cheap finance easily. This innovative financing will significantly help new small businesses to develop and progress technology, especially in developing countries. With this background, today's webinar brought policymakers, scholars, and experts to present best practices of the financial innovations that facilitate startups' access to finance and investment. I'm confident that today's webinar will allow all participants to deepen their understanding of innovative finance for technological progress. Moreover, I hope that today's webinar will be practically helpful for small businesses and a trigger for further leading research for this field for all participants. The webinar today is the joint event of the Tokai University, Iran National Innovation Fund, Technology Studies Institute, and Routledge publisher. I hope that after defeating this COVID-19, we can gather and organize our next joint events. Welcome all of you. Thank you.
Thank you very much, Professor Yoshikawa, for the clear and right to the point welcoming remarks. I appreciate it. So next, I would like to invite Dr. Siyavesh Malikifar, Chief Development Officer of Iran National Innovation Fund, for giving his welcoming remarks. Dr. Malikifar, please. Would you please unmute your mic? It's okay.
Okay. Thank you, Dr. Taghizadeh. Good morning, everyone. First, I would like to acknowledge my warmest greetings and welcome to you as our guests in this webinar. Ladies and gentlemen, on this occasion, I would like to thank the hosting institution, Tokai University, especially Professor Yoshikawa, and keynote speakers, Professor Yoshino and Dr. Mahramian, and the others of the book, Dr. Taghizadeh and Dr. Abu Jafari. The development of a knowledge-based economy in all over the world have been considered as one of national goals or priorities. This concept depends on innovation, but not any kind of innovation. I mean technological innovation, that means creating new technological products or services and commercializing them successfully. As you know, when we talk about innovation, it has many requirements, from human resources to infrastructures. Financing is also one of the requirements of the innovation, which has undergone many changes these days. As competitions becomes more complex and intense, and as the innovation ecosystems become mature, innovation financing tools are designed and implemented, and new institutions are born and formed. Consider an innovation ecosystem such as Iran, with a population of 18 million. We have more than 6,000 tech-based firms and hundreds of incubators, accelerators, and technology parks that support thousands of graduate students in entrepreneurship and commercialization. The number of our technology-based firms and startups is growing, and their exports have recently exceeded $1 billion. Until 2 decades ago, we supported the development of knowledge businesses mainly through debt-based instruments, and in particular, low interest loans. Gradually, however, new tools and institutions were set up in the innovation ecosystem that are able to develop new capacities. Today, in INIF, Iran National Innovation Fund alone, we offer more than 70 financial services to technology-based firms. For instance, one of the newest tools designed and offered in Iran is crowdfunding. We at INIF have accompanied our technology-based firms with insurance, which have been welcomed by our technology-based firms warmly. With this tool, we have injected the financial resources of the private sector, especially the citizens, into the innovation ecosystem. It's clear and crystal, we as Iran National Innovation Fund have the duty of funding innovation, but we have decided to be an innovative and learning organization. That is why constantly offer new services to our country's innovation ecosystem. For this reason, we have joined you in compiling this valuable book to learn from the experiences and lessons learned from other countries and to share our experience and lesson learned with you. I hope the experience of compiling this book is enjoyable and learning for all of us. Thank you.
Thank you very much, Dr. Malikifa, for your informative remark about the recent progress of startup businesses and tech firms in Iran. We appreciate. So next, let's move to the next part, which is keynote speech. So I would like to invite our first keynote speaker, distinguished keynote speaker, Dr. Mehran Mahramian Muallim, Deputy Governor of the Central Bank of Iran, for delivering his keynote speech. Please, Dr. Mahramian.
Thank you. Hi, everybody. I am very happy to be in this conference between the people from the Japan and Iran and the other parts of the world. It's a very good conference, and thank you, Dr. Taghizadeh and the other persons that tried to start this conference. So I am starting my speech about the Central Bank of Iran approaches to financial technology innovation. I am Mehran Mahramian, the Vice Governor of Modern Technologies of the Central Bank of Iran. And let's talk a little about some statistics on banking industry in Iran. You know that we have more than 30 banks and credit institutes in Iran. And the good news is that the 92% of adults are banked in Iran. It means that the financial inclusion is in a very good situation in Iran, and we have issued more than 500 million credit and debit cards in Iran, and more than 120 millions are active. It means that they have transactions within a month, and we have 4 billion card transactions per month and 122 post terminals per 10,000 population. It means that we have one of the highest rates of the post terminals in the world. So after the COVID-19, we experienced a very smooth change in the behavior of the market. It means that the people didn't encounter any problem regarding omitting the cash transactions from the society. And also the banknote to liquidity rate in Iran is about 2%, which is one of the best in the world. For example, this ratio in the United Kingdom is about 4%. So it means that regarding the banking and the banking transactions, we are in a good situation. And we are continuing this acceleration and this accelerated process to the new technologies. Let's have a talk on our national payment infrastructure. We have the central card switch. As you know, the name is Shetab, and also the Shaparak for the purchase switch, and the automated clearing house, and also the real-time gross settlement systems, and also the check imaging systems, which is named in Iran by Chakavak. And this national payment infrastructure is connected to the banks, and also banks are connected to the account information service providers, which provide some services to the people regarding the open banking systems. We have 12 payment initiator service providers. And at the same time, we have the e-pairs operators and payment facilitators. Good news is that that e-pairs operators and payment facilitators do not need license for starting their work. They can start their work by just having some contract with the payment initiation service providers and also some banks. So they can start their work very easily, and this is good. We have also a fintech hub. And the fintech hub means that we are providing, the central bank is providing some services some financial services to the outside actors and fintechs, and they can use these services to develop some and to combine these services with other services and produce new services for the people and high quality services. And also we are developing our regulatory sandbox that you know is very important these days, and I will talk more about the regulatory sandbox in the next slides. If we would like to talk about the central bank programs for supporting the financial technologies, I can mention some of them, like the cryptocurrencies and use of DLT and blockchain infrastructure in the banking sector and in the society. And also we can mention the sandbox, as I mentioned in the previous slide, and also the open banking as the one of the most important enablers of the neobanks. And now we have some operational neobanks in Iran, although they are working under the license of our current banks, but we think that they can be they can work as an independent bank in the near future, but now they are working under the license of the parent bank. And also some other programs that because of the lack of time, let me skip this slide. One of the problems that we had in the central bank when we talked about fintechs was that the organization in the central bank was somehow a traditional organization, and at the same time we had to do a lot of modern activities and modern tasks, and this made some problems in the central bank. So we started a project that lasted about more than 1 year, and now I am happy to announce that we will be able to announce our new organization in the modern technologies department in the near future, maybe less than 2 weeks. So in the new organization, we have some special parts for the fintechs and servicing the fintechs and regulating the fintechs. So I assume that we will be more agile, we will be better regarding the managing the fintechs, and at the same time we will be able to communicate better to the, for example, centers for financial technology growth and developments like the bank accelerators and innovation centers, to the regulatory accelerators and regulatory sandbox and banking and monetary regulatory in the central bank, and also the other institutions in change of the country's technology and the fintechs, and also financial technology associations and universities. At the same time, we have about 130 information systems in the central bank based on the information technology. It means that a lot of data, a lot of service can be provided to the fintechs, and now that I am talking, we have connected some of these systems to the fintechs, and we are providing some of our services via fintechs to the people, and I think that it can be extended to some other services in the future, and we are trying to do that. So we will be able to provide the right information infrastructure also for emerging RegTech fintechs. You know that many of the systems in the central banks are the supervision, based on the supervision tasks. So the RegTech can be very important for the central bank, and we are trying to regulate the RegTech infrastructures and RegTech ecosystem. So we will be able to use the fintechs as the RegTechs also. And also we are changing our architecture to a data-driven approach based on the advice of the Celent and the other big consulting companies in the world that advise the central banks to move to a data-driven architecture. I talked about the sandbox, the sandbox approach in the central bank, and you know that about more than 40 countries in the world these days are using the sandbox approach for managing the fintechs. And you know, this is because of some contradiction between the agility of the fintechs and at the same time the slowness of the regulation process in all of the regulators, including the central banks. How can we manage this agility? How can we use this agility to produce more GDP? We can tell that these days we are experiencing some revolutions in the economy that are produced by the unicorns, and these unicorns should be supported by the regulators. I think that the agility of the regulators can support and can produce a lot of GDP to all of the countries. But the contradiction that I mentioned is one of the most important obstacles regarding this. Some of the regulators, including the central banks these days in the world, are using this sandbox. In the sandbox, we let the newcomers and also the non-financial organizations and the companies to enter a new game. And some of them are from the different classification of innovations and from the different classification of technologies. They enter a portal and they can be registered in the portal. We have an executive team, and the executive team try to select some of the registered fintechs that are registering in the portal, and then they try to check our current regulations and our current law for producing the test, producing and designing the test plan. And after the fintech can start the test phase. After the test phase, the board can decide about allowing the fintech to be okay, and they can continue their work, or they may decide to extend the test phase, or they may ban the fintech, or they may recommend some change of the rules to the regulation codification bodies. And I think this can be a very good solution for the process of regulation of the new fintechs, and it can accelerate the penetration of the new fintechs in the society. In the Iranian Innovation Center of the in the field of monetary and banking, there are 26 innovation centers in Iran, and 87% of Iranian financial institutions have their own innovation center. The main objective of these centers are creating a synergy between banks and fintechs, and understanding and recognition of the fintech ecosystem, and supporting all sectors of innovative ecosystem. And also they service these fintechs, and they try to provide the appropriate technical infrastructure and APIs and access to the customer market, and also the possibility of both cash and non-cash investment, and the process of consulting and transferring experience and assisting fintech startups in regulatory issue. As my final slide, one of my final slides we have, because I have two slides here, let's talk about antecedents for capital absorption of the small businesses and also startups and fintechs. We have some individual factors like gender, for example. It is bad news is that the that the startups that they contain some male persons are more successful in absorbing the capital. And good news is that the startups that are fully equipped with women, I mean, they are full of women and they are women startups, are more successful. This means that we have some problems here, and I will mention that in the next slide. We have some problems regarding the race and ethnicity, and also the business startup experience. I mean, the people that are in the startup should be experienced for absorbing the capital. And also at the same time, the information asymmetry and nature of idea are very important, and also the geographical distance between the investor and the startup is very important. Most of the time, the investors do not invest in the startup which is located very far from them. So some policies should be made here to send the investments, especially to the underdeveloped zones in the country. And based on the things that I mentioned, we can tell that it is recommended that the startups with women founders use men in their team, especially in the phase of absorbing the capitals and accessing to the resources. And the government also should provide some special funding programs for women founders, and the government also should make funding plans for co-founders or teams subject to the gender diversity. The government should also provide special funding programs for minorities, and the minorities should diverse the teams and select the outsiders, and the founders of minorities should use non-minorities in their team to facilitate access to resources. And also the government should provide incentive for private investors to invest in startups that founders have experience with. The founder should use people with previous business startup experience in his team. And the investor and investee training is suggested to answer the parties' questions to reduce information asymmetry. And the government should give incentives such as special tax incentives, and the skill of expressing the idea in the simplest possible way should be strengthened by the founders. And also the government should provide tax incentives, salary grants, etc., to teams that have diversity to increase the attractiveness of this combination and increase the probability of success. Thank you for hearing my speech, and thank you also Dr. Taghizadeh and the other people that started the conference. Thank you. Goodbye.
Thank you very much, Dr. Mahramian, for the interesting presentation on the most recent development in Iranian financial system. As an Iranian, I have seen a large number of financial technologies which are existing in Iran, and I've used some of them, so I appreciate for this good activity. So next, let's have our second keynote speech by Professor Naoyuki Yoshino. Professor Yoshino is a professor emeritus of Keio University and director of Financial Research Center, FSA Institute of the Government of Japan. Please.
Thank you very much for inviting me. Can you see my screen?
Yes, it is clear.
Okay, thank you very much. Today, I would like to talk about a little bit different aspect about data analysis and big data analysis. Especially, I would like to focus on bank bubble and also the properties market. Non-bank performance is often affected by strong monetary policy. And after the COVID-19, many government has cash transfer and credit guarantee small and medium-sized businesses, and also very easy monetary policy. And in case of Japan, late 1980s, 181 banks went into bankrupt. And there are 5 reasons why banks went into bankrupt. You can see on the right-hand side of this table, one is real estate lending or housing lending. Then concentration to lending to certain sectors. Then number 3 is recession in local economy and failure in securities investment and criminal conducts. Those are the 5 reasons why banks went into bankrupt. But the real estate lending is sharing a very high reasons of bankrupt by banking industry. Credit unions, credit associations, there are several other reasons, but housing and real estates are the very important sector. So I'm going to talk about 3 measures how to detect these bubbles. One is real estate and housing loans comparison to total amount of loans. And second one is growth rate of banks' real estate lending compared to real economic growth. Third one is housing price in comparison to income. First, I'd like to look at mortgage lending compared to total bank loans. In Lehman crisis in the US, it was less than 30%. But now, during the Lehman shock, it went up more than 50%. So mortgage loans to total bank loans went up very significantly. The similar thing can be seen in Japanese case. And then recently, then secondary, real estate growth of the loans in comparison to economic growth rate. Because in production function, companies are using machinery, computer, labor, and real estate or land for their production. Then this property has to grow the same with their output. Otherwise, it shows some bubbles. And real estate, growth rate of real estate loans divided by growth rate of GDP. Japanese bubble, you can see it went up very high. The similar can be seen to US case. So we have to look at the growth rate of real estate loans in comparison to economic growth rate. Last one is the housing price divided by income is an important indicator. Many countries, speculation is going on. Then eventually those housing could not be sold to individuals. That happened in Lehman crisis and Hungarian crisis and so on. And when I looked at the Japanese bubble, housing price went up significantly compared to the base year of 1. It went up almost 3 times as much as income. Then US case, it also went up about 3 folds and then came down. And it is very interesting. The steady state is always the same in US and Japan. And this is the most recent property prices increase in Japan. After the COVID-19, central bank has very easy monetary policy, and many of them are targeting by banks to real estate and housing market. Then why housing and real estate has bubbles? Because there's a information asymmetry, and also the banks can lend money to constructors, and also housing and the housing demand. Supply side, demand side, banks can inflate them. For real estate companies, banks will first lend money, and then the demand for housing will start to rise. So price of housing first start to rise, but the construction will take 2 or 3 years. And then when the monetary policy became easy and central banks start to make loans to housing, real estate price will start to rise. And then after a while, supply is started to go up. And especially 2-3 years later, construction of building, housing start to significantly. But then at that time, demand for housing and speculative demand will start to shrink. However, the housing and real estate supply will be keep on going. Then the price will start to fall. this is the cycle of bubble and burst. So these are the seen phenomena in many countries. And services sector and manufacturing sector, these are strongly affected by COVID-19, especially in manufacturing sector. In case of Japan, automobile industry has been affected. These data are available monthly in Japan. However, real estate, housing, and banking data is only available quarterly or half a year or annual data. And then accumulation amount of credit rating has been started. And as far as banking behavior is concerned, I think timely information is very important for land price, housing price. In many countries, these data are lagged behind. Why? Because their data comes very slowly. However, recently, payment record is possible to collect by daily basis. Then it is better to capture the housing transaction from payment record, and also the real estate lending from payment record. So much more frequent disclosure and collection of housing price, land price, those transactions, those are very important to guess the importance of the phenomena of bubbles or not. So I think payment data has to be much more detailed, and it has to be well developed, whether those are housing transaction, whether those are consumption transaction, and so on. So payment data is very important by banks, and much more detailed analysis will be needed. Last point is about the credit guarantee after COVID-19. These credit guarantee, many countries are focusing on SMEs. And these credit guarantees are increasing significantly. And because of these credit guarantee, in Japan, amount of defaults are diminishing. And many countries, despite they are facing with COVID-19, total amount of defaults are diminishing because of various government support for credit guarantee. However, among SMEs, there are two kinds of SMEs. One is structural problem who are facing with it. So that will go into bankrupt even though there is a government support. Another type of SMEs, those are temporary decline of their sales. After COVID-19, they can recover very well. However, in current policies in many countries against SME, both of these SMEs are assisted by the government. That will make the structural problem for SMEs that may cause the big default losses for banks in future. So what would be needed is we have to look at the sales data of all the SMEs and production data, then cash flow of SMEs, payment data of SMEs are very important. So on-time collection of data, and then these sales and production and those data of SMEs has to be well gathered, and that should be analyzed very carefully. Otherwise, many countries may face with default losses, and then the lending to structural problem of SMEs, and they will become in default, and that will create the big problem of banking industries. So I think many people are talking about the importance of data, but I think data, especially for payment data, should be much more carefully analyzed, whether they are related to real estate, housing, and also the sales of SMEs. So those frequent data analysis, and that can provide us, which can detect the occurring of the bubbles in banking sector. So that's all my presentation. Thank you very much.
Thank you very much, Professor Yoshino, for the informative presentation and talking about this macro issue with policy implications on data accumulation, big data accumulation. Thank you very much. So let's, before moving to the session 1, so let's have a group photo. So I would like to ask all the panelists to turn on their camera, and we have a photo shot. So Dr. Abu-Jafari, Dr. Haydari, Dr. Lan, would you please turn on your 1, 2, 3. One more. 1, 2. Thank you very much. Okay, so with this, we can move to session 1. And at the same time, I share the links of the agenda and also the biography of the speakers or distinguished speakers. It is available in the chat box. So the first presentation is by Mr. Cedric Rimaud, fund manager of Earthquake Green Impact Fund of Singapore. The presentation is on what are the risks associated with innovative finance and policy. Mr. Cedric.
Thank you very much, Professor Farad, and good afternoon and good evening to everyone. It's a pleasure to be part of this webinar. So if we look at the state of global finance at the moment, as a result of loose monetary policy and also the concentration of capital in developed markets, there is a lot of investments that are looking for returns and are not getting them. In the fixed income markets, a lot of the investments are getting negative returns, for example. So naturally, investors are looking for new ways of getting returns by investing in new innovative areas, which carry a number of risks. So in my presentation, I would like to focus on one particular area, which is the rise of thematic finance in the global economy. Investors are increasingly allocating capital according to extra financial parameters. Normally, investors must look at the financial return before allocating their capital. But today, there is an increasing focus on parameters that are not financial. The rise of thematic finance includes parameters that are relatively recent. If we look at, for example, green bond, social bonds, sustainability bonds, ESG bonds, SDG-linked bonds, and so on, there is an increasing number of types of securities that promise to investors outcomes beyond the mere financial return. This is a good thing, as our world needs to adapt to the challenges of our times, i.e., for example, climate change, or the rebalancing of our societies after a big crisis of the COVID-19. However, this carries a number of risks. The first one is that the definition for those thematic labels is relatively new and it hasn't matured yet. So there is a large number of thematic labels that have been created and that can create some confusion among investors. I already cited green, social, sustainability-linked bonds, ESG bonds, SDG-linked bonds, blue bonds, resilient bonds, COVID bonds. We see more and more of such instruments being bought by investors, and the framework for those investments remains yet to be developed. Different regions have developed different standards. For example, China has developed different taxonomies, and some of them have been developed by different regulators within China, which led to the need to harmonize among regulators a common language around green finance. The European Union has developed its own taxonomy. The US will need also to develop some guidelines. And each region developing its own standards, that creates some differences that investors have to deal with. In the emerging markets economies, there is also the need for such definition, and sometimes there is a conflict between local context and what global investors need to see in terms of harmonized standards. Those standards also are mostly voluntary. They carry relatively little penalty if they are not complied with. For example, the issuance of a green bond is really around the use of proceeds that the borrower will make of the capital that is being raised, what type of projects they are going to invest. They need to segregate the funds for specific investments and specific assets. However, there is no guarantee that those assets will perform, and there is always the corporate guarantee of the issuer as a backstop. But these types of instruments are relatively new. They have really started in the last 2 or 3 years to reach an amount that at the end of 2020 exceeded $1 trillion. And if we add the social bonds, the sustainability bonds, and the rest, we are almost approaching $2 trillion globally in terms of the amount of issuance. That's a very large number already, even though the bond market itself is about $130 trillion in size. But the size of those instruments is already almost half the size of the Japanese GDP, for example. So this is a very significant number. So the question remains, what if those extra financial parameters are not complied with? Investors may may not get what they want in terms of outcomes. So that remains to be seen. There is maybe a role that regulators need to play in terms of ensuring that those extra financial parameters are complied with. There is a risk of litigation if this outcome is misunderstood or misrepresented as well. Labeling investment can be sometimes fluctuating depending on the state of the business. They may be subject to economic shocks that may reallocate capital to different uses from what was originally planned. There can be also some conflicting objectives in these types of investments. If a company issues a sustainability bond, for example, it may promise green investments as well as social outcomes. What if there is a conflict between the two? How are these resolved? There may be also some additional cost of compliance with these extra financial frameworks, which may limit the capital flows from investors to, for example, emerging economies, where the cost of issuance may be prohibitive for some businesses. Also, the investors' risk appetite may shift over time. Currently, there is a very strong appetite for this type of thematic instruments, but this may change as the investors may become more aware of the credit risks that are embedded in these securities. In terms of risk management as well, there are new types of risks that investors are considering that have to do with maybe the lesson learned from this current crisis, or also from climate change and the repricing of assets as a result of the shifts in our environment, like in the real estate sector, for example, or in sectors where there is a big transition coming through technology, for example, in the oil and gas sector, or more widely in the energy sector, or in the automobile sector, where there is a shift from internal combustion engine to electric vehicles, for example. This may carry some new types of risks as well. And the question is still out there whether there will be defaults as a result of these transitions, and whether these defaults will affect the interest in those types of securities. I'm not willing to speak of a bubble yet, because this market is still relatively new and only represents about a bit more than 1% of the total market. But as Professor Yoshino showed in his presentation, bubbles have existed in the past, coming from different various angles in the financial world. And this is something that needs to be monitored and analyzed. And that's what I will be trying to do in this section. Thank you very much.
Thank you very much, Mr. Cedric, for this interesting presentation. So this chapter is, I think, is very important chapter, like many other chapters. It's going to talk about the risks and how to cope with them. So next presentation, I mean, the agenda mentioned that it's by Dr. Hayatberk Said Aliyev. However, he's not available, and his co-author, Dr. Kamzabek of Süleyman Demirel University of Kazakhstan is going to present it. So the presentation is on financial inclusion, financial innovation, and macroeconomic stability. Please.
Hi, can you hear me?
Yes, it is clear.
Oh, thanks. Actually, I'm the third author, and I am assisting Professor Liqing and Hayatberk Said Aliyev in this topic. So topic is financial inclusion, financial innovation, and the macroeconomic stability. Initially, we took roots from the financial inclusion and macroeconomic stability, because the macroeconomic stability comes from the crisis from the financial systems, particularly in the Great Recessions, United States, and in crisis in 2009. So financial stability attracts considerable attention. And since then, countries set their legacy goals to reducing the share of non-performing loans to support stability in the financial system. And we tried to answer that question, how we can deal with financial stability through the lens of the financial inclusion. So it means financial inclusion basically means you providing financial service to poor populations and attracting all of them to the financial services. However, if then we dig into the financial inclusion, how we can explain the financial inclusion, and we propose that the main financial inclusion is tightly linked to the source of financial innovations that banking system currently utilize. Hence, we put some hypothesis that macroeconomic stability depends on not innovation per se, but which kind of financial innovation spread over the country and spread over the financial institution. So how we can approach to the innovations? So in overall, in most macroeconomic studies, we have the abstract view of innovation. However, if you look at the organization studies, how they can classify the innovations. Clayton Christensen, the main well-known author, they classified into three types of the innovation. We have the disruptive innovation, we have sustaining innovation, and we have efficiency innovation. So disruptive innovation or new market innovation means so you basically come up with a new business model and new product innovations, and then making the product affordable and accessible, okay, to many population. Sustaining innovation means you need to you denote incremental modification in traditional business models, and efficiency innovation implies it comes from the organizational doctrine. So it implies eliminating assets, increasing net cash flow via automation and declining costs. Basically, it's about profit maximization. So you can notice here that disruptive innovation is the first type of innovation, and the efficiency innovation is the third type. They are attributed to make the product affordable, accessible to many population, while traditional banking system, most majority uses sustaining innovations. So, but what are the main objectives of our study? So generally, we try to examine the impact of financial inclusion and macroeconomic stability. Then we basically, and more, we want to examine the hypothesis of whether the financial innovation may help to construct a financial system to eventually lead to macroeconomic stability at both macroeconomic level at the same time as macro banking level. So let me first of all, okay, let's talk about fintech innovation. The first question is fintech innovation is disruptive innovation? So what the literature says, it provides a low leverage solution and it requires heavy equipment. So the answer is yes, fintech innovation is disruptive innovation. Disruptive financial innovation may come up with the forms of crowdsourcing, blockchains, artificial intelligence, machine learning. And what's the advantage of using the disruptive innovation such as fintech is it requires heavy capital first of all, and it has the job creative nature. So you need to hire a lot of employees in order to in disruptive innovations. And you can notice here that in the United States, the share of shadow banks, which majority use the fintech technology, almost doubled since 2007 and between 2007 and 2015 by reaching a high demand in lower income minorities, and as well as in small and medium enterprises. What about other types of innovation? Efficiency innovation and sustaining innovation. So another stream of the research in macroeconomics, they found that recently we have the decline in the total factor productivity and the labor productivity and the diminishing impact of innovations after 1970s in the United States. So Acemoglu later on in 2019 explained it might be due to the acceleration process of optimization and the deceleration of the process of reinstatement. Basically, it means so we have the pace of automatization outstrips, overshoots the pace of the reinstatement. So it's that's so we have the problem with the unemployment rate during the efficiency innovations. And another third type of the innovation, it's organization operation tend to move incrementally and usually remains the same product as its inception. So traditional banking system, if they come up with a new product, we call it sustaining innovations. For example, traditional mortgage systems are borrowing from the banks. And what Acemoglu said in an American Economic Review that there is indeed exists a stable balance between disruptive and efficiency innovation. However, what we come up with as a novelty, so inequality between disruptive innovation and efficiency innovation indeed may induce instability in macroeconomics. So here we are. As the nature of sustaining innovation is predictable, the main concern touches the efficiency innovation and disruptive innovations. How we can balance the efficiency and disruptive innovations. Efficiency innovations may eliminate the jobs, even though it makes the product accessible, affordable, accessible, and may increase the inclusion. However, it may cause the weakening of stability via unemployment. While in terms of disruptive innovations such as fintech, machine learning, artificial intelligence, we have a main concern in disruptive innovation. So usually in regulations, we tend to pursue the ex post approach. It means so we detect a possible risk only after the fact, after the crisis only. So the technology-led business models may foster systemic risk. This is the main concern. So fast credit has a potential to undermine loan-to-value caps and hence increase the credit risk in the market. So it means it may induce a systemic risk, which is the main concern regarding the disruptive new fintech innovation. In terms of methodology, I think I should skip it because Dr. Heidberg should explain it. Our result basically. So our result reveals that the effect of the financial inclusion on macroeconomic stability is heterogeneous. So the first type of innovation, disruptive financial innovation, that makes the financial service affordable and accessible, have a positive effect on stability, while further inclusion tend to trigger the vulnerable segment of the population enrollment to mainstream financial system, which eventually leads to instability of the financial system. Second, efficiency innovation makes financial services affordable, accessible. However, pressures stability by shrinking the labor market. And the third, sustaining innovation traditional banking system seems to be inefficient. So our policy implications, so this implies that the policy to improve the financial inclusion status are of the great importance and they could contribute to escaping the middle income trap. To this end, our empirical studies helps to shed light on the dynamics of the financial system stability and is associated with the financial inclusion. So we need to find a balance between the disruptive new market innovations and then we need to have a new regulation on the disruptive fintech innovation. At the same time, balancing the disruptive innovation with the efficiency innovation in order to keep the macroeconomic stability. Okay, thank you very much.
Thank you very much, Dr. Khamzabek, for the presentation. This is also another interesting chapter. So we will have a Q&A session later. Before that, I would like to invite Dr. Kiarash Fartash of Shahid Beheshti University, Iran, for presenting the general overview of this chapter, which is going to be on role of national innovation financing agencies in promoting startups. Dr. Fartash, please. Dr. Fartash? Dr. Fartosh, are you here? Are you with us? I cannot hear you, unfortunately. Okay, so till we have Dr. Fartosh, let's have our discussion on these two presentations. So I would like to invite Professor Yoshino for kindly discussing these two presentations.
Okay, thank you very much for two presentations. First one is Cedric remote. I think it is very important ESG and greenness. There are many different definitions, as you pointed out, by regions and also. And investors are now taking into account not only risk and return, but we have to pay attention to sustainability, greenness, or ESG. And furthermore, each rating agencies define ESG greenness differently. So that is another problem. And many institutional investors all over the world hire one of the rating agencies or consulting companies. And then they decide how to allocate their portfolios based on ESG or greenness. However, each rating agency and consulting companies have their own definition. So that may distort portfolio allocation, which used to be based on risk and return. And that is one point, and I completely agree. So there are two ways to solve those distortion. I think one is, rather than using ESG or greenness index, one can introduce globally the GHG tax. And if that tax CO2 plastics can be charged same tax rate to all over the world, then automatically rate of return will become lower if their exposures are large. And if the tax rate is the same identically to all over the world, that will neutrally affect to those countries. And second proposal, another one is unified credit rating or unified definition of greenness or ESG. As you pointed out, each region has different definition. Then that will distort portfolio allocation. So globally, World Bank or some international organization should set up unique definition. Thirdly, there are excess investment in those ESG or greenness, because some companies are targeting ESG criteria for 30%. Some companies are setting it up 40%. So they would like to change their investment 40% based on greenness or so. Then as you pointed out, that has nothing to do with risk and return. Then that may cause another additional risk. So I completely agree all of your points, but my proposal is what could be the solution? So solution could be GHG tax globally, and also the unified single credit rating that could be needed. And second paper, Hayat Bank Sadaraliyev, I think disruptive innovation and financial system stability, that has to be coexisted. That is the main message of the paper. But I think there is some another aspect. If banks can go together with innovative finance, so the new technology can be absorbed by the banking business, then it is not a disruptive innovation. It will be an inclusive innovation. Existing financial institutions can include those innovative methods. Then it seems to be financial system stability and innovation could be possible. So what Japanese FSA is doing is traditional banks can set up their new innovative company outside of the bank. And then they are working together so that the current existing banking business will become much more innovative. So that means it is not a disruptive innovation, but it's an inclusive innovation. So those are the comments. Thank you very much. Very good presentations.
Thank you very much, Professor Yoshino, for your comments. Mr. Cedric, do you have any response to the comment? So if there is no response, so let me also have one comment and question to the second presentation by Dr. Kamzabek. So this is interesting presentation and interesting chapter. So in the literature of financial inclusion, when we're talking about financial inclusion, so we are mainly looking at the availability of financial products, affordability of financial products, and accessibility to the financial products. However, you in your chapter, you brought a new aspect, which is efficiency of the financial products. So how do you want to measure the efficiency? So this is a question. Secondly, although the chapter has an implication for financial technologies, but since this is a candidate for a book on financing, on innovative finance for technological progress, so in preparing the final chapter, I'm requesting you to focus more on the term financial innovation, financial technologies, and your study needs to provide a recommendation on how to make the accessing to finance easier, so to be in line with the scope of the book. So if you have any response, we would be happy to hear. Efficiency, how are you going to measure the efficiency? I cannot hear you. Would you please unmute your mic?
Yeah, thanks for your comments. Yeah, I take notes. In terms of efficiency innovation, we measured in how unemployment rate increased while during the innovation. Particularly, we take efficiency as an automatization process. So how the process of automatization causes also being laid off by the banking system. We took this notion as efficiency innovation. Yep. In terms of disruptive, yeah, I take notes and we will work on it.
Okay, thank you very much. But this efficiency is not very clear, so please think more on this, okay? Because it will be questioned by the readers that what does the efficiency means.
Okay.
Okay, so let's see if Dr. Fartash joined us, if the technical issue solved. Dr. Fartash, are you here?
Hello. Yes, I'm here.
So, would you please share your screen? And we are running out of time, so if you can make it faster.
Yes, I will try to catch up. Okay. Can you see my screen, Dr. Taghizadeh?
Yes, it is clear.
Okay. I'm very sorry. It may look very funny, but the problem is because of overconsumption of electricity in the building I work, it's Vice Presidency for Science and Technology. They usually ask us to cut off the electricity for 2 hours. And we go on these 2 hours with our generator. But today, the problem is, today they decided to do it on 10:30 and we don't have a UPS. So the problem happened. Usually they do it on 12 to 14, but it was my unlucky day. So the chapter I proposed is to investigate the role of national innovation financing agencies in promoting startups. This is a chapter we're going to write with my co-author, Ms. Dareshiri. Briefly, the outline of our chapter is to first discuss and show why innovation innovation matters. Then we're going to discuss on startups and agents of innovation. Why they're they are a productive agent of conducting innovation. Then, so if we accept startups and as agents of innovation, what would be the mechanisms and tools to support them, particularly from the financing perspective? Then, to show the mechanisms and tools, I mean, to provide some practical evidences, we're going to study some financial agencies that are focusing on innovation. To do that, we selected 11 innovation financing agencies in 8 countries, and at the end, we're hoping to provide a holistic policy mix of innovation financing mechanism. It would be not just for developing countries, but also for developed countries. And we're going to try at least to capture the differences of different nations, different countries. So as I lost some time because of this funny problem I already told you about, um, I'm going to skip some of the slides, but here, as the second part of our chapter, startups as agents of innovation. We know a startups face many difficulties. One of them is financial difficulties, which should be addressed by financial support. And this is the perspective we're going to focus on. All, of course, there are many other issues that should be addressed if we're going to support the startups. But given the scope of this book, we think this is the perspective that should be under scrutiny. So, on the mechanisms, we know that when we want to provide financing for startups, usually what comes to our mind is the traditional financing agencies, banks, I don't know, these credit institutes. But the problem is they don't see startups as a different player with some specific characteristics that should be uh, viewed as differently from a big firm, from a well-established company, a multinational company, or even a SME. So there are many categories and classifications of financing tools and mechanisms which are specifically designed for startups. And, and this is where national agencies comes in. Uh, as we may see, as we may know, most of us, we know that there are, and for the fact, Dr. Maliki Far was a keynote speaker in the beginning of this webinar. Okay, he is a top manager in one of these national innovation agencies. Countries are establishing, countries are dedicating resources, attention to a specific, to specialized agencies to support from financial perspective. So we can see there are many countries, there are many national innovation financing agencies, and we selected 8 countries. We try to have a holistic approach to include both developing countries, developed countries. Specifically, I wanted to include Iran as well because I come from Iran. I know a little bit Iran National Innovation Fund, but we will also cover South Africa, Russia, China, France, Malaysia, Norway, and Canada. And in some country like Malaysia, we're going to investigate more than one innovation agencies. The term innovation financing agencies, by this we mean that an specialized agency, organization, whether it is public or private, that is supporting startups or supporting startups from the financial perspective. So at the end, we hope to provide or to discuss on the differences and similarities of these financing tools and mechanisms in terms of scale and scope of support, in terms of whether they're supporting or covering demand or supply side, whether they're covering some stages of innovation process more than the other stages, or maybe some of them are have limited their support in some stages, and also the different roles these innovation agencies play. Like some of them, we can say they are investor, co-investor, mentor, facilitator, matchmaker, supporter of commercialization, and etc. We can, this list goes on. These are just some examples. And based on the commonalities and differences, we believe that this policy mix would be useful for not just financial institutions in developing countries, but also developed countries, and not just for the financial institutions, but as well for policymakers to have a broader view of the tools that they should pay attention to. So these are in principle what I wanted to discuss or present in this webinar in more details, but due to the fact, to the technical issue, that I wasn't the guilty one for that. But anyway, it happens. So I'm very sorry for that. And I try to be as quick as possible.
Thank you very much, Dr. Fartash, for the presentation. Professor Yoshino, do you have any additional comments on role of
Okay, thank you very much. I think the paper needs a little more examples and details because it's very vague and just idea. And some of the supporting data will be needed, especially financing for startups. What kind of mechanism is going on? And please give us the examples of success stories to promote startups and what kind of case studies you have. I think, and some of the case studies, startup financing may be difficulty and some have been succeeded. Then what kind of startup financing is successful? So those examples will be needed in the chapter, and that will be very good for other countries. Thank you very much.
Thank you very much, Professor Yoshino, for the comments. So I also have some additional comments. So I think the chapter is interesting, but it needs to be improved, as Professor Yoshino mentioned. And ultimately, when you are comparing all these cases, providing policy implications from your study, from the success cases, and in order to increase the efficiency of this system, in order to increase the role of national innovation funds in a startup financing. For example, one point that needs to be considered is that national funds needs to avoid crowding out effect of the private investment. So it means just entering to this market when private sector is not able, or the private sector is not interested to enter. This is one point. Another important point is the role of credit assessment. So although it is public money, but it doesn't mean that lending to all startups who are entering to the organization. So credit assessment is very important. And among the successful cases, I suggest that you add a KfW of Germany. So in the cases that you are studying, KfW of Germany and JFC of Japan. Japan Finance Corporation also has good experiences that if you can add in your study, that would be better. Okay, so if there is any response from Dr. Fartash, or if there is any other question from the participants or panelists on these presentations that we have.
Dr. Taghizadeh and Dr. Yoshino, thank you both for your very constructive comments. I would do my best to include all the comments to the best of my ability. KfW is a good suggestion, although it's mainly works on renewable energies. But anyway, it's a very good success story. I would include that, as well as JFC. I will try to include implications both for the governments as well as the agencies, and also success stories and difficulties. I will try to include them. Although it's not an easy job, but I will do my best. And thank you for your comments. And again, sorry for my technical problem.
Thank you very much for making it. So if I haven't received any question from the participants, so to save the time, let's move to session, the next session, session 2. So before that, I'm expressing my thanks to the presenters, Professor Yoshino, for discussing the paper, and to participants. So session 2 is on regulatory and policy framework. We are going to have 3 presentations in this session. The first presentation is by Associate Professor Dr. Pornchai Visotisak of Faculty of Law, Chiang Mai University, Thailand. The presentation is on regulatory frameworks for startup crowdfunding in ASEAN countries. Dr. Pornchai, please.
Thank you, Dr. Fahad. Let me share my slide. First of all, I would like to thank Tokai University. Thank you. Thank you, the Iran National Innovation Fund and Technology Study Institutes, and all of the hosts, especially Dr. Fahad and Professor Yoshino. Today, I would like to present, just to keep on time, I would like to present the topic on law and regulatory frameworks for crowdfunding in some ASEAN countries. So this presentation is from the preliminary draft of the paper. So the author of the paper will be me, which is Dr. Pornchai from Chiang Mai. And then I have my very close friend, he's now in our Zoom as well, Dr. Nguyen Ba Bin, which is the Dean of the Hanoi Law University. And also we have the Professor Andrew Terry from, he is a Professor of Business Regulation from Sydney Business School. So this is a team of our paper. We're mostly working on franchise law. However, we seem to have kind of interesting on crowdfunding in some countries, especially in ASEAN. That's why we come up with this paper. So let me move on to the next slides. So this is the outline of our paper. I will go very quick because we have so many slides. Anyway, we will explain the aim of the paper, and we will explain the overview of the crowdfunding and definition of the crowdfunding in our paper. Then we try to study on the frameworks and law and regulatory frameworks in Singapore, in Thailand, and Vietnam, and we come up with some preliminary conclusion of the policy implication as well. Let me start. The aim of the paper is to explore the overview of how countries in Singapore, Thailand, and Vietnam deal with the crowdfunding by legal enforcement frameworks of laws and policy. And then we want to compare them together. And at least by the comparison, we can show them what are the proper or what are the appropriate, or at least the best or the good frameworks for some countries in ASEAN country. The reason we choose Singapore, Thailand, and Vietnam is exactly because Singapore is developed economy, Thailand and Vietnam is still in developing economies. So that's why we try to compare within the ASEAN with the developed economies and developing economies. And you see that there are similarity and difference in each country on law and policy or regulatory framework on crowdfunding in each country. Okay, so before I move on to the regulatory framework in each country, it is important to note that our paper defines crowdfunding as the means of the matching of business funding interest of investor and project owner through the use of crowdfunding platform, and which consists of any following activity of facilitation and granting of the loan. So it means that the crowdfunding is the platform for loan and loaner and loanee to come together to get the money and to satisfy each other through the platform. So this is our definition. The definition is from the US law and policy as well. So this is the overview of the crowdfunding that we set up in our paper. Then let me move on to the second. So we study on the international first. You can see that in US, they use Security and Exchange Commission to be the agency that can have the authority to govern the crowdfunding. And they set up the rules that give the power to the US SEC. Then the US SEC can formulate their regulation easily by adopt the new declaration, by the sub-declaration, in order to permit the crowdfunding to move forward. However, in order to support, they have the concern to protect the investor as well. So according to the laws and rules in US, they say that the SEC mentioned that they require all transactions that have to be under the regulation of crowdfunding and to take place online through the SEC registered intermediaries. It means that every system has to be under the control or under the governance of the SEC. And also move on later, the rules of laws in the crowdfunding in US, they mentioned that the maximum of the amount that can be raised from the crowdfunding is 5 million through 12 months periods. So this is kind of the aims to protect the investor and to limit the balance of the volume of investment, not to be very high. Okay. And so if you move on, then the rules say that limit the amount of individual to non-accredited investor that can invest within the 12 months as well. So this kind of the law and regulation that aims to make sure that the crowdfunding is not too big and that create the problem to the investor, and also to protect the investor into the market as well. And most of important thing is that the SEC mentioned that according to the regulatory framework in US, they require disclosure of information in filing to commission. It means that the platform has to disclose all the information to the SEC in order for SEC to oversee and to govern the system of the platform. By this point, by rules of regulatory frameworks, it means that SEC can oversee the market or oversee the platform of crowdfunding easily, and to make sure that there will not be fraud or misleading crowdfunding in the system. Yep, let me move on to the Australia. This is the slide from Professor Andrew Terry. He kindly gave the slide to me, and then I just update it later. In Australia, it's the same as it's similar like in US. They use the ASIC, which is the SEC. I mean the Security Commissioners of Australia. In Australia, they say they enact or they pass the amendments, the corporation law, which allows the crowdsource funding in 2017, and also they amends the Corporation Act in 2001 in order to make sure that the laws permit the frameworks of crowdfunding. Because normally in the normal and traditional ways of corporation will not be easily raise the fund from the platform or from the public. Only in the case that they are in the stock market, they can raise the fund in the stock market. However, by this change, the Australian government through the ASIC, they permit the platform to use the crowdfunding to do the raising the fund for the crowdfunding. However, until in 2017, the CSF, this is the crowdfunding, was available only to the wholesale investor. But later on, the current CSF regime was introduced in 2017 through the change of the law, and they permit some kind of crowdfunding in 2018. This is the update. Today, according to the regulation in Australia, the CSF is limit to 5 million as well, and within 12 months. So it is look similar, but just different amounts in USA and in Australia. And CSF have to offer only through the dedicated CSF intermediaries. It means that the AFS license, before raising the fund, you have to get the license from the ASF as well. So this is kind of the story from Australia. I will go quick. I think that I have to go to the other slide as well. I understand that. So in EU, it looks similar because they adopt the framework of regulatory framework.
Only 1 minute left.
Only 1 minute. Okay, I'm sorry. So sorry because it's prepared. If you go to Singapore, they use the same, or not the same, but similar type of the thing, but they differentiate between lending, equity, and reward donation. And also they adopt the laws policy to offer the crowdfunding. And if you see that there's the small offer, private placement, institutional investor, accredited investor, altogether is under the framework of law in section 272A in Singapore Financial Authority. So this is the system that Singapore used. I've got quick anyway to Thailand. Thailand used the same system that SEC is the commissioner, and a commissioner has the power to issue the subordinary laws to govern. For example, I use we call in Thailand is notification of capital market, a notification of the capital market concerning the crowdfunding. So they limit the same with 20 million, which is about 800,000 US dollar per year or per crowdfunder. So this is the story. I'm not going into detail, but anyway, move on to Vietnam. You see that Vietnam is starting on the P2P lending. However, they still haven't got any specific regulation in order to hedge the risk of the P2P lending within the crowdfunding. So this is the important point, that Vietnam tend to be slow. However, they move a little bit forward by the Prime Minister's order to have the specific law on crowdfunding in Vietnam. So let's come to the conclusion. I think there is some similarity on international framework, and within the Singapore, Thailand, except Vietnam, that moving a little bit slower. However, they're going to adopt the same, according to my assumption. But the policy implication is that too much regulation, it means that you're stopping the crowdfunding. However, it should be the right-hand regulation, not to be limited too much. And that should be the first advocacy for the SME and startup in countries like, for example, in Thailand and Vietnam, because they still don't know anyway, not know much about crowdfunding. And the crowdfunding should be easily accessed for the SMEs. And there should be the balance between the crowdfunding business and protection of the crowdfunding investor as well. Most of all, if possible, it should be the regional framework for ASEAN countries by basing on this example. Sorry to take your time, but I prepared a lot of things for you.
Thank you very much, Dr. Pornchai, for the interesting presentation and for making it faster to be within the time. So next time, I would like to invite Dr. Saqib Ben Amin, Associate Professor at North-South University of Bangladesh. So the presentation is on institutional and regulatory requirements for innovative fintech in Bangladesh. Dr. Amin, please.
Thank you very much for it. Am I audible?
Yes, it's clear.
Okay, so good afternoon to all of you. My name is Saqib Amin, and I'm working in the School of Business and Economics at North-South University, Bangladesh. The title of my today's presentation is Institutional and Regulatory Requirements for Innovative Fintech in Bangladesh. Why does it matter? So this is a joint work with Professor Taghizadeh-Hesary, Farhan Khan, and Mahtab Khondokar. So at the outset, I'd like to thank Professor Taghizadeh-Hesary and other distinguished organizers for inviting me in this webinar. So Bangladesh, a country in the northeastern part of South Asia, has made remarkable progress over the last 1 decade in terms of the socio-economic point of view, such as increased per capita income level, life expectancy, literacy rate, poverty reduction, so on and so forth. You can see from this slide, like Bangladesh economy grew by 7% on an average since 2010, and extreme poverty was reduced to 10.5%, which was around 32% in 2010. So the country is now known as the new Asian tiger for the remarkable progress and becomes a role model for the other South Asian countries. So now what is our next vision? With an objective of becoming a high income country by 2041 and to reduce extreme poverty by 2030, Bangladesh now looks forward to achieve sustained economic growth, for which fintech can play a very crucial role. So as we all know that fintech can improve the business payment systems, customer relationship management, better invoicing and collections, innovative business and startups, so which are all important from a country like Bangladesh perspective. Okay, so different literature has already mentioned that fintech through digitization can lead to many different business revelations that can ultimately mitigate the prevailing distortions from the conventional banking industries. Therefore, fintech has the potential to create more economic opportunities, generate jobs, which will in turn provide stimulate the economic activities. Also, what is evident that after the financial crisis in 2008, many companies have faced difficulties to mobilize resources from the conventional banking system. Moreover, there were increased consumer dissatisfaction surrounding the banking system. So the emergence of the new technologies and this exponential increase in the level of mobile and internet penetration worldwide facilitated the fintech industry to grow at a very faster rate. As you can see, the growth of average capital investment between 2014 and 19 was around 132%. Okay. And we can also actually see that investment through fintech can be linked to different SDGs, as mentioned by Hinson et al. In 2019. So historically, Bangladesh economy was characterized by a relatively underdeveloped financial system and lack of access to the formal credit market by a large number of rural population. However, increasing mobile phone penetration and associated mobile financial services industry in Bangladesh has emerged as a strong platform, opening up with many alternative financial options. Non-banking fintech company, for example, bKash, becomes one of the market leaders in the country in mobile money services, where you can pay through a mobile phone or computer. And there are different policies, initiated by the government and the Bangladesh Bank, which is the central bank of the country, to facilitate the fintech innovation. For example, you can see the digital financial services lab, a joint initiative by Bangladesh Bank and A2I, has been developed to assist rural e-commerce and increase financial literacy. The Bangladesh Bank has also have an MOU with the ICT division of the Bangladesh government. And also we can see that the central bank has recently introduced a regulatory innovation office for fintechs under its payment systems department to better oversee the financial services providers and tech startups innovating around digital payments and other banking services. So what is the main objective of this paper? So not paper, the book chapter. Even though Bangladesh has progressed in terms of fintech that is specialized in e-payments, the development of other fintech methods like peer-to-peer lending, crowdfunding, credit rating companies, and partner financing blockchains are still, insufficient. So in this book chapter, we argue the existing barriers, institutional regulatory drawbacks, and absence of adequate policies, which may cause the slow progress in different types of fintech utilization and also discourage larger scale investment on fintech. We also aim to provide a set of policy guidelines for the fintech development in Bangladesh to achieve 2041 targets. So it is obvious that the changes in the financial market due to the augmentation of fintech have led to several challenges, especially in the wake of the fourth industrial revolution. Regulators have faced different challenges originated from the use of new technologies and the appearance of new actors like new banks, fintech companies, tech companies providing financial services, and other conventional financial institutions who are actually in process of augmenting the digitization. The existing regulatory and legal structure may face challenges surrounding the fintech innovation in terms of the speed of adoption, higher disintermediation and convergence in industries, borderless platform, and high degree of heterogeneity in services. So besides, the propensity of fintech activity development also reduces considerably due to the market uncertainties and asymmetric information in the absence of the regulatory and legal structures. At the same time, it is also a very important policy concern, like who is going to be the regulator? Is it the private or public regulator who should come forward to address these challenges? We know that different types of regulators vary in terms of their authorities, jurisdictions, means of enforcement, and also operational in terms of operational efficiency. So this is also very important aspect to actually know. So the centralized, what is the existing, institutional and regulatory framework standings in Bangladesh? So the centralized decision-making process in Bangladesh acts as a major barrier to the development of the fintech technology due to the absence of the authority or administrative power within the local administration. There is always a significant delay in the formulation and implementation of the fintech policies. So the existing centralized mechanism requires that all the policy decision needs to get the approval of the relevant authorities. So moreover, the lengthy bureaucratic procedure also hinders the development of the fintech opportunity in Bangladesh. This is one of the area actually we need to focus, for example, how we can actually increase the opportunity of the fintech development by breaking up the existing systems. Regulatory legitimacy is also a critical to define and ensure administrative support, formal rules, compliance, and bureaucratic effectiveness. Due to the lack of regulatory legitimacy, potential large investment and sometimes become challenging for the development of fintech innovation. But what is good to see that the recently established office by the central bank is a great initiative which will help them to better focus on addressing the regulatory knowledge and to attain a better understanding of how technology is impacting the financial service markets, and also assess the need for reforms to the regulatory framework for digital financial service. We also feel that there is a necessity for cross-industry partnerships, collaborations among the key stakeholders in the country's financial service ecosystem. A number of partnerships among banks, mobile network operators, fintechs, and microfinance institutions have failed to bring the expected market outcomes due to the conflicts of interest. Okay, so this is another important area we need to focus. And previously, Dr. Mahraman very excellently mentioned about the importance of the regulatory sandbox. In fact, Bangladesh Bank can also adopt a regulatory sandbox approach, because we can see that more than 45 countries in the world are working with sandboxes in their jurisdictions. So a regulatory sandbox may provide a safe harbor for businesses to test inventive products, services, and business models which are not protected within the existing regulatory framework. So a regulatory sandbox is always very helpful for the providers and regulators like a country Bangladesh in a way for it can reduce the uncertainty for the market players, substantially reducing time for seeking approvals. It can offer a better understanding of opportunities and risks, providing an opportunity to test new regulations in a controlled environment. Okay, and also for the promoting collaboration in the digital finance industry. So in this chapter, actually, we are going to propose a set of policy options surrounding the fintech industry in Bangladesh, because we believe that while Bangladesh has made notable progress in accelerating the financial inclusions, challenges are still remain on both the excess of users fronts. Okay, so demand for technological disruptions in the sector is all the more accurate, and it is also very important that around 50% of Bangladeshis are still unbanked. So financial like innovation, fintech innovation will play a very, very important role to achieve the 2041 visions of Bangladesh economy. Thank you very much for your attention.
Thank you very much, Dr. Amin. The chapter is interesting, and thank you for your contribution and for your presentation. So next presentation, the third presentation of this session is by Dr. Esra Alp Coşkan from Tokai University of Turkey. So the presentation and chapter is on the role of governments in the development of financial innovations. Dr. Esra, please.
Thank you. My name is Esra Alp Coşkan, and thank you for inviting me to this webinar. Today I will present our book chapter, which is called The Role of Governments in the Development of Financial Innovations. We will analyze and discuss the role and the responsibilities of governments in the development of financial innovations. And first, I will give our discussion on the theoretical background of our research, what the economic theory says about the financial innovations and technological developments, why does it matter, why is it important, and then I will give our motivation of the study, and then I will discuss the expected policy implications. First, the technological advancements, for example, financial innovations, startups, unicorn companies are all considered as technological advancements, and these technological developments are considered in endogenous growth theory in the economics literature. In endogenous growth theory, which was suggested by mostly Arrow, Romer, and Lucas in the late of 1980s, and it suggests that not only the accumulation of capital, but the development and accumulation of knowledge and technological change leads to increased and sustainable growth, and long-term growth is linked with the technological developments and also financial innovations. And on the other hand, when we look from the Schumpeterian perspective, according to Schumpeter, the state, the governments should play an active role in the economy, and they should act as an entrepreneur for the risky investments. They should invest to risky companies because they have to start the first wave of the development, economic development. This is how Schumpeterian perspective thinks about the technological developments, the role of government in the financial innovations. And the risky projects usually involves some infrastructure investments, and these kind of investments are generally expected to be done by the governments. And this is very important in according to the role of governments. And in line with this idea, the Industry 4.0 ecosystems also implies the same developer role for the governments, usually for the high technology and research and development investments, innovations and startups and unicorns and other high-tech companies generally. The government incentives is very important for small and medium-sized business and startups because they serve as a driving force behind the innovation and technology-based economic growth in both advanced and emerging countries. These technological developments and financial innovations is very important because, as I said before, they lead to sustainable and long-term growth in mostly, particularly in emerging countries. And our chapter is going to focus on the need, mechanism, and possible scope of the government supports initiatives for the digital finance entrepreneurships and the emerging new digital baby industries. What are the developments of technological innovations? What are these developments? These are artificial intelligence, big data, distributed computing, cryptography. These are technological progress. These define the technological progress. And new technologies in finance sector is peer-to-peer lending, fintech companies, blockchain technology, robo-advisors, and unicorns, high-tech companies, as we said, startups. They contribute to economic growth in two ways. First, they provide new and easy opportunities to access traditional and also alternative financial instruments, credits. And second, they increase the competitiveness of the sector based on the technological innovations. Actually, there is no common definition for fintech, but we can say that fintech is a technology innovation in financial services that could result in new business, applications, and products also, with an associated material effect on the provision of financial services. We will focus on especially fintech in our chapter. And when we look at the pros and cons in fintech, we see the positives and negative sides of fintech, financial technology, digital finance. What are these pros and cons? They may help to minimize information asymmetries. These are positive sides of fintech. They improve price discovery, financial inclusion, and contribute to efficiency of the financial markets. But there are also some negative sides of fintech. What are these? New forms of interconnectedness, increased dependencies to third-party service providers, and eventually disrupt And Dias defines that underlying technologies of fintech as application programming, artificial intelligence, machine learning, Internet of Things, big data analytics, distributed ledger technologies, and they also involve blockchain and cryptography and biometrics. And what are the recent developments in financial innovations? As we look quickly to the numbers, we see that for the decades, there is a growing number of fintechs, startups, and unicorns in the worldwide. For example, 85% of the companies say that they are working on the strategies to create partnerships with startups. And also, when we look at these numbers, the number of fintech firms in 2018, and we see the numbers in the red, in the parentheses. These are the recent numbers. As we see in America, the number of the fintech firms is doubled. And in the Europe, Middle East, and Africa, the number has tripled. And also in Asia Pacific region, the number is tripled in only 3 years, in the last 3 years. There is a growing number of fintech firms and startups, and also the revenues also is expected to increase from 92 billion pounds to 188 billion in 2024. This is the expectation of the Deloitte, and I put the link also here, which is available. And what are the difficulties of financial innovations? Actually, when a technology grows, it may have some negative sides. For example, in digital finance or in the other technologies may cause unemployment because they do not need more employment because everything is going to be digital. So the unemployment may also cause a declining economic growth. This is also a negative side. And it is valid for also advanced and emerging companies. And some studies also find some relationship which is not positive between the startup rates and the economic growth, and it depends on the country's stage of development. And for 55 countries, Haddad and Hornuf investigates that if the economy is well developed and venture capital is readily available, then the countries witness more fintech startup formations. If the country is more developed, then these fintech technologies seem to be more successful, but it is not valid for emerging countries. In emerging countries, this kind of developments may also cause unemployment and declining economic growth, surprisingly.
The time is limited. Would you please move forward to the...
Okay. We will discuss the difficulties of the financial innovations. These difficulties are such as financing investment infrastructures and scarcity of skilled talent and the taxation system, so, flexibility of taxation system. But the main problem is accessing to traditional and alternative finance channels is the biggest problem because, as we know, according to Basel rules, the banks cannot finance risky sectors or risky companies. So these startups and unicorns involve a high level of risk and they can't find enough credits and enough financing. So we are discussing that the government should take this active role, as economic theory also suggests, as Schumpeter or the other Arrow, Romer and Lucas suggest. The government should take the active role and act as an entrepreneur and invest into these risky sectors and risky companies. And because government doesn't need to get the quick returns like impatient finance demands, and the governments also can make profit. And we have some examples from Silicon Valley. For example, Apple shared rewards with the government. And in NASA and other small business innovation research program, they are all examples that governments are successful and they make profit from these risky investments. They don't need tax subsidies or low interest rates. And states some advantages compared to private firms and banks. Private firms pay taxes and they need low interest rates. They can run out of money. They can't spend more than their budget, but governments may spend more than their budget, and generally they do this as a policy. And they can use public funds, and these are more trustable financing options for lenders. And so the governments should take these advantages and act a very active role for the economic development based on technology and financial innovations. Our policy implications are generally in line with these discussions. And our chapter will discuss all these theoretical and practical experiences, and also we will give some examples for real-world experiences, the successful examples of the governments such as Silicon Valley, as I said before, and we will end our chapter in this context. Thank you for listening.
Thank you very much, Dr. Esra, for the presentation. This is also interesting chapter. So next, I would like to invite Dr. Rohullah Abu-Jafari, who is the Director of Knowledge-Based Economy at Technology Institute, and he's the co-editor of this book, and we are organizing this event together. Dr. Abu-Jafari, please.
Hello, good morning and good afternoon, everyone. Do you hear me, Dr. Farhad?
Yes, it is clear. Please.
At first, I should thank you because of the organizing this webinar. And first of all, I should thank to all our contributors, author of chapter. And secondly, appreciate our keynote speakers. Especially, I am happy to see Professor Yoshino again. And to this sector of the panel, about the subject, I want to remind some points. You know, we are on the transition to the industry 4.0, and the regulation is very important because of the new phenomena will occur. As a Donny Roderick, industrial economics says, we passed the question of the government intervention. The main question is how to government can intervene to facilitate the growth. So on this transition, we have some disruptive technology. You know, disruptive technology will lead to profound changing in the society, economics, and also culture. So we need a policy rationale to government intervene and intervention and policy and regulation. So as a first chapter that about the crowdfunding in ASEAN, I want to mention some points. At first, I thank to the authors. One of the most important subject of the book is the fintech and crowdfunding as one of the part of the fintech. At first, we should discuss about the relation between other fintech and crowdfunding. In the chapter also, the author mentioned about the P2P. I want to mention blockchains or smart contracts will use in the crowdfunding. I think that we mentioned about that. And the second point about the first chapter is that we should provide a conceptual framework about the aspect of the comparison. For example, between Vietnam and Singapore. For example, how tax system deal with this investment? Or is there any guarantees provide for the crowdfunding investment in this platform? I think that this would be helpful and useful for the other country to learn about the policy implication of that chapter. And the second chapter was from the Bangladesh about the institutional and regulatory requirement for innovation. I think that the research questions should be more clear. The conceptual framework is, should be provided, especially how we should answer to the question how to mitigate between the intervention of government and the market. If we have over-regulatory of the government, the ecosystem will harm. And this is the main question of the chapter 2. And chapter 3 of this session about the role of government in the development of financial innovation. After the reviewing of the theory, I think that it leads to the policy rationale of the government intervention. I think that if we want to contribute to the literature, it's good and it's useful to do a case study of Turkey, because this chapter review the literature and some fact and stylized fact about the fintechs. But if you want to be more useful, the case study of Turkey and how the government facilitate the financial innovation and regulate the startups in the Turkey is very useful to the other country. Thank you very much again for the authors, and I'm here to if any question.
Thank you very much, Dr. Abu-Jafari. Before I invite the presenters to have the comments, before I ask Professor Yoshino, I also have one comment. So two comments. So on the chapter by Dr. Ponchai, this is an interesting chapter really. However, there are 2 points. Since the chapter is on ASEAN, so please focus on ASEAN rather than US for us to and secondly, ASEAN shaped to promote the regional trade, transaction, and ultimately the economic integration in Southeast Asia. So meanwhile, it would be interesting for the readers of your chapter to answer to this question. What policies your chapter can provide for the unification of crowdfunding regulatory frameworks, so that investments easily come from Singapore to Vietnam, from Singapore to Cambodia, from Malaysia to, for example, Vietnam, and so on. So whether it is possible, if it is possible, how? So this is important. Secondly, regarding Dr. Esra's chapter, so this is interesting chapter. Just I request that please focus more on the topic, because majority of the presentation was explaining about the background, fintech, because we have other chapters that explain about fintech, about challenges of financial innovation. So please focus on the topic of your chapter, which is role of governments. And as Dr. Abu-Jafari mentioned, I also agree, bringing case of Turkey, because we don't have Turkish chapter in this book, bringing case of Turkey, in addition to reviewing the literature theoretical background, would add to the value of your chapter and will make it more interesting. Professor Yoshino, do you have?
Thank you very much. As far as the Dr. Ponchai's chapter, in Japanese case, we have asked credit crowdfunding to formulate their own association by themselves. So there are 2 levels of regulation. One is FSA is top. Then crowdfunding themselves has created their own association, and they check monitor by themselves. So there are 2-step regulation. So that is another way. It is often used in Britain. Britain asked each institutions to formulate their own association, crowdfunding association. Then they have self-regulatory watching each other. And that could be the best way to reduce the regulatory cost. And Dr. Ezra's chapter, your point is the government should have a role in risky sectors. But sometimes government is difficult to screen good innovative fintech and bad innovative fintech. So how would it be possible for the government sector to screen the prospective fintech versus declining fintech? Otherwise, debt accumulated to the government and deficits will be accumulated. So I would like to know what is the mechanism whether the government can screen the good companies and bad companies. That will be a very important lesson. If other developing countries follow, government should do it. Then they will just fail, and then accumulation of debt will come to the government. That will be the worst case. And so I would like to know what is the secret to screen good company versus bad company. Thank you very much.
Thank you very much, Professor Yoshino, for your good comments. Dr. Pornchai, do you have anything to add or respond?
Yes, thank you for the comment. And it's important that could Professor Yoshino tell me about the agency again, so I can update the agency into this, right?
Okay, it's a crowdfunding association. Crowdfund. I can tell you later on. Okay, so they formulate their own association in between the regulators. So crowdfunding come together. So FSA has initiated to have a self-regulatory organization, and they monitor by themselves. So that is a two-step regulation. First step is coming from crowdfunding association. They formulate by themselves.
Yep, thank
and
you.
that
That's
will reduce the regulatory costs. Thank you.
Thank you.
Very good. Thank you very much. So Dr. Esra, Dr. Saqib, anything to add or respond?
I'm fine. I will. Sorry, go ahead, please.
Okay, thank you for the comments. We will actually add the examples of Turkey in our chapter, but we couldn't include in this presentation because of lack of time. And the other topic, what is the secret for governments to select good companies to invest in? We will focus on this issue, and also we will focus on the role of the government, as our chapter is actually has to say something about this. And thank you for all comments. We will consider all these in our chapter. Thank you.
Thank you very much, Dr. Esra, Dr. Saqib, Dr. Pornchai, for your presentation, and I hope that these comments can help all of us to improve the paper, improve the chapters. Okay, so thank you also, Dr. Abu-Jafari, for the comments and discussions. So let's wrap up this session, and we are going to have a break. Let's make the break shorter, and we will come back about 4:15 Japan time and 11:45 Tehran time. So see you in a few minutes. Hello again, welcome back. Let's continue the webinar with session 3. In this session, we are going to have 4 presentations. This session is on innovations in institutions, product and processes, best practices and policies. And the first presentation is by Dr. Mehrnaz Haydari, Tarbiyat Modares University. The presentation is on role of financial matchmakers in innovation financing ecosystem, the case of financial matchmakers in Iran. Dr. Haydari, please. I cannot hear you. The sound is not clear.
Can you hear me better?
Yes, it is clear.
Okay. I guess I need to hold the presenting time. So can you also share my, hear my screen share?
Yeah, it is.
See my screen share?
Make it full screen, please.
So.
If possible.
Better?
Possible. It is okay. Yeah, it's okay.
Is it okay? All right. Thank you. So good afternoon to participants from Japan, and also good morning and noon to participants from Iran. I'm going to talk about the role of financial matchmakers in innovation financing ecosystem. The idea is actually raised from practical problem that startups face during their fundraising. I am going to present this on behalf of my co-author as well, Dr. Hodini Furusha, and also actually working in a consulting firm which provide startup financing service as well. So the idea actually, as I mentioned, is the practical problem that has been seen in startup fundraising process. So as it's clear, startups need money in various stages of business development for their product development, for business model test, for marketing, and so on. And they usually have difficulty in obtaining financing, especially in debt financing, because of the lack of their credit history, not having um, good, financial statements, and not availability of providing some securities. So there exist special types of supporting vehicles for startup financing, such as venture capital funds, accelerators, angel investments, and so on. But there still exists financing.
Dr. Hesary, the voice is not very clear. Would you please keep the mic closer? Thank you.
Yeah. Is it better now?
Yes, it is better. Yeah.
All right. But there still exists financing gap between startups and investors. In the literature, there are a lot of causes has been mentioned about the financing gap, but among them are the information asymmetry between startup and investor, which causes difficulty in due diligence and evaluating that make it difficult for investors to create efficient deal flow. And from the other side, the startups don't usually have a strong network as well. And they don't completely understand the strategies of investors and the language of actually the investors. And this funding gap also is happened in Iran's startup ecosystem as well. As you know, Iran's innovation financing ecosystem is relatively young. Also, there are almost 6,000 approved new technology-based high-tech firms, which can be considered as a sound market for investors. But the low contribution of venture capital funds in financing these high-tech startups, can be interpreted as the funding gap in Iran's startup ecosystem as well. As Iranian Capital Association has been reported in the last 7 or 8 years ago, in the last 7 or 8 years actually, the number of venture capital deals has been less than 500. And this can be, addressed from different perspectives. Maybe the macroeconomic situation of Iran, or the government's direct supporting vehicles or direct debt financing providing, that set aside the investors and venture capitals to invest in such high-tech startups. If I want to show the Iran's innovation financing institution at a glance, you can see the different institutions that provide financing in different stages of the startup growth. From R&D, there are some science and technology parks and a lot of incubators that sometimes provide grants or provide small debts. Actually, in the seed stage, there are lots of actually accelerators in Iran. Most of them are active in ICT sector, Fintech sector, and so on. There are a little number of accelerators in industries such as oil and gas, energy, and water, but the number of accelerators in ICT sector is actually outnumbers the, in industrial and hard tech, maybe startup acceleration. There is also crowdfunding platform which provide maybe microfinance for startup projects, and the investors are mostly not smart investors. They just provide money. Also, there are some individuals as angel investors which provide seed money as well. In the early stage phase, 50 science and technology funds are active in Iran that provide both equity financing and debt financing. There are venture capital firms, there are venture capital funds. Also, the National Innovation Fund provided debt financing for those new technology-based firms, and it has started co-investment with other investors as equity financing as well. In the maturity phase, and of course, there are banks and stock market that can provide financing. So there are lots of institutions in Iran's innovation financing ecosystem, but there is still a gap can see between startups and investors. So in this article, we address these questions. What critical barriers startups face during fundraising, especially in high-tech companies, from the firm level actually. And would an institution with matchmaking functionality can resolve these obstacles? And if so, what are the key success factors should it have to perform efficiently? In the literature, the role of financial matchmakers has been mentioned as well. The matchmaking is the activity of encouraging investors and entrepreneurs to form a relationship to facilitate knowledge and financing flows. The matchmaker can assist investors in deciding which project to fund, due diligence and valuation, and monitoring these projects. And also, on the other hand, from the startup side, matchmakers can help the entrepreneur better understand the investor's strategy and insights. So to address those questions, we adopted qualitative approach. We did structured and deep interview with 30 startup finance experts and adopted thematic analysis to understand the main internal barriers at the firm level to startup fundraising, as well as the most important key success factors of matchmaking institutions. The main contribution of financial matchmakers or brokers actually in innovation financing ecosystem can be monitoring startups and facilitating startup investor relations. Also, the matchmaker can create investment by increasing the visibility of less known high-tech startups. They can lower the cost of investment by providing economies of scale. The matchmaker can screen and adopt due diligence and investigate the startups and match them with different investors in their network. And also, they can assist investors in decision-making process. And the most important success factors of matchmaker institutions that they should have strong networking in the innovation ecosystem, both in investor side, in high-tech companies, in mentors, in the other value creators in the value chain of the startup as well. They should have high mentoring abilities. They should have financial and technical evaluation ability in different sectors. And most important, they should have independent governance structure. They shouldn't have be related to other investors, to specific investor actually that can provide their due diligence independently and match the startups among different investors in their network. So financial matchmakers can be considered as the missing piece in Iran's innovation financing ecosystem. One can say that the crowdfunding itself is a matchmaker. I would say yes, but first of all, they provide microfinance. But maybe most of high-tech companies and startups need smart money as their investors to finance them and provide non-monetary actually services for them as well and values for them. One might also say that accelerators can be matchmakers as well. I would say that they are not independent because they are related to startups. They have invested in the startups. They have provided pre-seed or seed money for the startups, so they are not independent, and their due diligence or their screenings and evaluation and valuations might not be that independent from perspective of the investor. So they can help in creating efficient startup investor relations.
Time is over.
Yes, I'm finishing this. And finally, the policymakers support these matchmakers by starting some proliferative programs, providing them some sound legislations and promoting them in the ecosystem. Thank you.
Thank you very much, Dr. Hesary, for the interesting presentation. Let's move to the next presentation, which is on deploying machine learning and big data to promote MSMEs access to finance in Japan and application to other countries. So it's a joint chapter by Ms. Megumi Sagara of Credit Risk Database Association and CRD Business Support of Japan, and Dr. Lan Nguyen of CRD Association and CRD Business Support of Japan. Dr. Nguyen, please. I cannot hear you. Would you please unmute your mic?
For her, can you
Yes.
hear me well now?
Yes, I can hear you.
Yeah,
Just
sorry about that. Maybe I should share my screen again.
yes, please.
Okay. Okay, here we go.
Yeah, it's good.
Okay, is it all right? Is it in full screen now for her?
Yeah, it's clear.
Okay, great. Thank you very much. Good afternoon, everyone. I am Lan Nguyen of Credit Risk Database Japan. Together with me today is Ms. Megumi Sagara, our Director of Overseas Division also in the Credit Risk Database Japan. So our chapter today, thank you very much for inviting us to this project. Our book chapter will be covering the topic of how to deploy machine learning and big data to promote the SMEs access to finance in Japan and in other countries. So we'll be talking about our experience in this field. So our book chapter will be covering some context in credit assessment for SMEs, and then a little bit of our introduction, what is credit risk database in Japan, and our most recent approach using machine learning for transactions data in Japan. And finally, it is our also current overseas project to build up a credit risk database in the Philippines. Okay, so as you all know that MSMEs have several ways to raise funds for their business activities. They have traditionally raised funds from banks via bank loans and recently turned to other sources, which is the online lending, crowdfunding, social lending, so on so forth, thanks to numerous innovation in fintechs. So amidst the great differences in services, speed, fees, and one thing that traditional banking and alternative banking have in common is the approach that they have towards assessment of borrower creditworthiness. So the lenders always want to know if the borrowers have the capability to repay on time or not. So, but unfortunately, for SMEs borrowers data, we often do not have enough data of SMEs so for the lenders to be able to make the correct and timely assessment. So if there is a database for SMEs, the information, it will not be overboard to say that such data will become very important financial infrastructure for the financial as well as the SME sector. So credit risk database in Japan is a database managed by the CRD Association. CRD also, of course, stands for Credit Risk Database, who really gathers financial data in financial statements from our member banks and members credit guarantee corporations. So CRD Association has built a credit risk assessment model that based on large volume of data and helps create a financial structure for the SME sector. In this chapter, we will introduce our organization, this initiative, and also examines the feasibility of establishing the similar kind of financial structure in other countries, including our project, which is underway in the Philippines. So again, CRD credit risk database accumulates a large number of financial statements and qualitative information. It also gathers the delinquency information, which is the loan performance data. From this large database, we build a statistical scoring model that helps to evaluate the SME's ability to repay the loan. So our database is on anonymous basis, which means that the CRD database doesn't have a reference function for to look up the performance of any SMEs. So the bank or anyone cannot look up the specific SME's performance in our database. Instead, as we built a scoring model, a score for a new SME client can be calculated, apply such a model, and the score can be assigned to the SME. Since it's unnecessary to identify particular SMEs in our database, all of our data is on anonymous basis. So the database contains information of not only incorporated SMEs, but also sole proprietorships. So currently there are above 30 million historical financial statements collected so far since 1995. Okay, in this book chapter, we will also be sharing one of our recent initiatives in the recent years that involve the use of different type of data that goes beyond the scope of the financial statement data. So we use transaction data as a new attempt to explore the data that all the financial institutions or bank already have existing in their system. So transactions data, it refers to all of the cash inflows and cash outflows out to and from any SME's bank accounts. So this information is actually have been there for a very long time, as long as the SMEs have a deposit account. So, but it has not been explored, but only until recently that the banks realized that they have such a large pool of data. They decided to explore how to use this data into credit risk assessment. So this term is only recently. So transactions data refer to all of the movements of cash inflows and cash outflows, as I mentioned. Cash inflows, it refers to all type of revenue, returns on investment, proceeds from financing, and outflows including payments for fixed costs, variable costs, and other investments. So as I mentioned earlier, this transactions data is a huge data set. It could be billions of data points per month. So the machine learning approach was used to analyze this data. Since we all know that machine learning excels in processing complex and large amount of data, and it's also very good at finding patterns that leads to delinquency or underperformance of any particular SME's cash movements. So to our surprise, this machine learning approach actually surpassed the traditional models, especially in the shorter term, which is 3 months to 6 months. So as you already maybe can imagine, our biggest challenge while developing this model is to arrange these billions of data points into meaningful subsets of variable categories, which is the cash inflows, outflow, and balances. which would allow us to have to be able to interpret the result of the model or the model outcome. So the rest of the chapter, it will be discussing our project overseas, which Philippines is the first place that the first country that we try to establish the credit risk database. This project is based on the discussion between the Japan International Cooperation Agency, JICA, and the Central Bank of the Philippines. So the project started in 2020, the Technical Cooperation Project. It attempts to build the similar type of database for the Philippines by collecting data from the Philippines financial institutions. The project actually built a project implementation unit, PIU, within the premise of the Central Bank of the Philippines. And the CRD Japan Credit Risk Database Japan was assigned as the official consultant for the project. And we are going to transfer technology in all technology related to creating the database to the central bank's staff. So, the technical cooperation doesn't start without any feasibility study before that. So 3 years before the current project, we have to do a feasibility study to actually study what type of data that are available in the Philippines. So the feasibility study was conducted together with the 3 government-affiliated financial institutions in the Philippines. They help us to provide data, and we create a prototype model out of these 3 financial institutions' data sets. So we confirmed that there is a possibility to build a scoring model based on the financial statements in the Philippines. And during this feasibility study, we also try to apply the Japanese scoring model to the Philippines data, but it turns out that the model performed very badly for if we do such a thing. So we find that it's necessary to collect the Philippines data so that the scoring model will reflect the Philippines SMEs sector more closely, right? So that's why after this feasibility study, the current project called the Technical Cooperation Project also starts for 3 years, and we are going to collect the financial data of SMEs from more 20 plus bank in the Philippines. Okay, so for this chapter, we think that there are key takeaways from this chapter is that building a financial database for the MSMEs will be the very key important infrastructure for the banks to be able to assess the credit worthiness of SMEs correctly. And also the banks could explore their existing data to find out if there are any data that they already have that could be used for the modeling of credit risk assessment. Such as in our case, we have found that transactions data or the cash inflows, outflows from a bank's account could be powerful in predicting the SME's future repayment pattern. So in this chapter, we will try to review as much as possible about our machine learning approach. But we think that these 2 infrastructure, both the traditional financial data from financial statements, as well as the transactions data from the bank account transactions. They would work well together, and there are potential for other countries to apply these two infrastructure model. Okay, I think that would be all from my end to share with you.
Thank you very much, Dr.
I hope I make it on time.
Yes, very good. Thank you very much. It's very
Thank you.
Yeah, thank you for sharing
Thank you.
experiences with us and in this chapter. I appreciate it. So let's move to the next presentation. The third presentation of this session is by Mr. Fadet Charoen Sivakon of National Credit Bureau of Thailand. Mr. Fadet is going to present on National Credit Bureau and institutional financial innovation for boosting SMEs finance in Thailand. Mr. Fadet, please. I cannot hear you. Your mic. Would you talk, please?
Can you hear me now?
Yes, please.
Hello?
Yes, I can hear you. Yeah.
Okay. Can you see the screen?
Yes.
Okay, sure. All right. First of all, I'd like to thank you to Dr. Farhat and the professional Yoshino to ask me to join this webinar and also in the book chapters. For listening to all the presenters in this afternoon, I think the book will be is going to be the good book, and that'll be the interesting book as well. And I hope that all my information that I'm gonna sharing to you all within 10 minutes would be benefit for the reader in once the book has been complete. So let me start the presentation now. For my presentation, I will start with the historical background of the credit bureau in Thailand, and then we'll touch a little bit about the laws of the bureaus. And then the next will be the concept, how we develop the technology innovation into our services and products. And then we're going to share you how we support the financial institutions and what would be the new ecosystem to support the credit worthiness assessment, and also the limitation of the law and the legislation. So I think you probably know about the 1997 when we have the start with the Asian financial crisis. At that time, there is no credit bureau, so it means that there is the asymmetric information happened. There is no centralized information, and at that time, NPL is about 47.3%. It's pretty high, right? Next, in 1998, we asked the funding from the IMF, and then 2000, we set up the two credit bureaus. 2002, the law has been enacted, and 2005, we merged two credit bureaus together, and then amendment the law has been started in 2008 to provide the risk tool that we call the credit score and the statistic report. At the present, we have been launched the credit scoring since 2016. And what we are looking forward in the future that we can collect the alternative data, which is very important to help the credit worthiness to be improved in the futures. So our role is just providing the information to the members, which is defined by the laws. And then we also produce some statistical reports for our members, and also sometimes to the investor that they want to know about the bureau data in Thailand. So the law has been started with that who can become the members. Right now we have banks, we have non-banks, Japanese non-banks, we have the Thai credit guarantees, and we also have the some saving cooperative to allow to be the members by the laws. But unfortunately, some financial institutions such as the Fintech, they cannot become the member now, right? So we collect the data, 3 years of the credit historical, and then there are 2 channels that they can access to our information. One is through the members, but the member needs to get the consent. The consent is as the paper that the borrower needs to sign and allow the bureau to share information to the lenders. Right? And then the purpose of the inquiry of the getting the information is just for the acquisition of the new loan only. Right? And also they also provide for the credit review as well. The other channel is through the sale inquiry. So the sale inquiry is been defined by the law that the consumer has the right to know what information has been sending to the credit bureau so they can check whether information is being correct or not correct. So I highlight the e-consent and e-KYC, which I can talk about in a few minutes. And also I also highlight the e-report for the sale inquiry channel. So our database has 2 types. One is the consumer database, and another one is the commercial database. For the consumer database, we have around 30 million subjects or 30 million borrowers. And then for the commercial, we have about 300,000 millions borrowers. For the record, we have about 118 millions. And then for the commercial, we have about 4 millions. So with this information, last year we have 70 million transactions from the members access to our information. And then we have around 107 members now. For the statistic information, this is very specific objective by the law. It's not openly for the public or research, right? The objective needs to be for the financial study, to be specific for some research company, which is allowed to touch to this database. So for the consumer, we can go back to 2009. And then for the commercial one, we can go back to 2007. So with this kind of information, they can study what happened and what is going on into the historical of the financial situation in Thailand. So the concept of the service and products. So these are the concepts that we are always thinking when we want to launch the new service or the product into the market. So first of all, we follow the Thai financial system structures. So in this picture, we just only the part of the credit assessment. And we are providing information and some tools for the lenders to make the decision and give it the credit to the consumer. The second one is the credit worth assessment revolution. This is the Bank of Thailand perspective. In the past, I think we are no ways about if you don't have the land, you cannot get the loan, right? So with this kind of the specific type of the information here, they provide low financial accessibilities. So and then they are moving forward to the risk-based lending. But the risk-based lending is not supporting all the startup entities, right? So right now, at the present, they are thinking of using the information-based lending, which is I heard a lot of big data which is going on during these afternoons, and making the decision based on the borrower behaviors. I think this can be boost up the digital lending market at the current and also in the futures. So the third one is a platform. So platform right now is very critical for the digital lending. Even though the bank cannot have their own platform, they can join with the e-commerce platform or some others provided platform to giving the lending process within their platforms. In the platform itself, data is also very important. And even though the e-KYC is also very important to the platforms. So this picture is showing you how information-based lending has been implemented into the financial market at this moment, especially in China. As you can see that they can know the buyer and the borrower, right? And then the merchant itself and also the borrower and the buyer, they can know very well through the information that's been happen in transaction on the daily basis. The key highlight of this process has been that you need to provide fast and convenience. And one of the things is that you can have to provide the platform in any time and anywhere, right, to provide the convenience to the consumer. So we also follow the framework of the credit bureau in the doing business. You can see that this is the similar structure that we have that I showed you in the previous slide. This is the data provider. This is also the service provider. We have in the framework of the both bank, they have defined the credit provider has two types. The first type is the credit register is normally is owned by the government. And the credit bureaus normally is maybe joint venture or owned by the private companies. For the products, in this picture, they have to provide the macroeconomic views by providing the statistic informations, and this one is providing the microeconomic views to the users, right? In Thailand, NCB is providing both the macroeconomics to the government, to the Bank of Thailand, right, to study the household debt crisis, historical, and the issue that happened into the household debt crisis. But this one is just only the member can be access to this type of the products. So, and how do we support the financial market? In the financial market, they have two types of the lendings. One is called the statistical based lending decision, and also another one is called the expert based decision. For the statistical based decision, I think this one should be more customer centric analysis. So right now we're just providing the credit reports, the credit scoring to both lending both consumer and also the commercial database. So this is just to implement.
The time is over. Would you please?
Okay, sure. All right. So I will skip this one, and then I would like to highlight of data needs for the SMEs. Right. One of the big challenge of the small business is the identifications. So in order to be recognized of this real traditional trading entity, one way is that you have to allow information to the public facing the website, and then they can be used. Another one is to knowing their business performance. This one is also known from the open banking. Another one might be the social media data and some others big data that's going to be implemented. So I just want to identify that the alternative data is also important. In the future, there's going to be combination between the bureau data, which means the credit worthiness data plus the alternative data, right? So once the data has been combinations, this is a picture of the digital lending. You can borrow the money or buying the car in your fingertips, right? Just as fingertips, and then you can go on the mobile and the application. So we are respond to the financial infrastructure by providing the eKYCs, and then be thinking to build the SME intelligent information that's going to be happening in the futures, right? So this is comparing traditional. You need to face with the lenders, and you need to sign the form, right? You need to ensure your copy ID and everything until you get the loans. But once we have the eKYC, we have the digital identity platforms, we can transform from traditional lending to the digital lending. So this is going to be the big picture in the future, that everything will be connected together, and everything needs to be the consent to share information. Right. So right now, the policy implications, we are in the process of the law amendment, right? And to complement with the issue that I mentioned in the previous slide about asymmetric information for the fintechs, and also the data cannot be accessed to the some other financial institution. These two types of the policy stand would be changing pretty soon, probably in the next couple of years. Challenge would be the regulation, privacies, right, data qualities, and the market practice. This would be the critical factor that's the regulatory or regulator that should be thinking when they implement the policies. So to be conclusion is that consumer have been shift their behaviors, right? Technology also have been shift, and also regulatory has also been shift. So this thing had to be going together to have the better digital lending in the future. Thank you for your kind attention.
Thank you very much, Mr. Fadet, for sharing the experiences of NCB, which are valuable and interesting for other countries. Thank you very much. So the final chapter of this session is by Dr. Syed Ali Fatemi. The title is Role of Credit Guarantee Scheme in Funding Technology-Based Firms in Iran. So Dr. Fatemi, please start by sharing your screen.
Hello, everybody. Is my voice clear?
Yeah, just please speak louder. It's not.
Is my voice clear now?
It's clear. Please share your screen.
Hello, ladies and gentlemen. It's my pleasure to have a presentation in this webinar. And I hope that I will have a quick and precise lecture that suits your valuable time. I would like to say that I'm here on behalf of my kind and helpful supervisors, Dr. Tabatabayan, Dr. Taghizadeh, and Dr. Qurbanizadeh. Let's start with credit guarantee. We can consider credit guarantee as an institutional innovation in financing SMEs. But why an institutional innovation? Because in financing, we have a two-way relationship between lender and borrower, and guarantee institutions, credit guarantee institutions that we call them credit guarantee funds, come across this two-way relation and make possible kind of relationship banking between lender and borrower, or the firm and the investors. Generally in SMEs, credit guarantee have the potential to leverages other available financial resources and facilitate the lending process, and especially lower the cost of financing SMEs, which is a really important problem in financing SMEs. Also, we can mention credit guarantee as an innovation in application context when we talk about credit guarantee for technology-based firms. You know that NTBFs, technology-based firms, have lots of difficulties with their assets, with their collaterals, and how to cope with them when they are financing from, for example, banks or other credit markets. Credit guarantee funds, credit guarantee instruments can lower the problems caused by information asymmetry and heterogeneity of technology-based firms, which is a root cause of difficulties of these of financing these firms. And kind of relationship banking can happen if credit guarantee funds come between technology-based firms and, for example, banks or other investors, other lenders, and facilitates this relationship by using soft information and translating this soft information for lenders. In Iran, use of credit guarantees was mentioned under supervision for many years, not only in rules, instructions, but also in services provided by different funds. Here we have Iran National Innovation Fund as a government fund, which facilitates bank guarantees. We have research and technology funds, which are non-government bodies, non-government funds, and have guarantee services in their services. They offer guarantee services. And also we have some other guarantee funds, other public and governmental guarantee funds in other sectors, like, for example, export or cooperative investment, which can, potentially they can offer guarantee services to technology-based firms. In the suggested chapter, in the offered chapter, we think and we argue that there are lots of more opportunities in credit guarantee, and in Iran, as we have a developing move toward credit guarantee, we still have lots of capacity in credit guarantee that we can use to boost up technology-based firms financing. So in this study, we try to identify current patterns in Iran CGS, in Iran credit guarantee system, and try to find the root causes of these patterns and have some suggestions for upgrading and adjusting these currents. But I talk about patterns. What do I mean by patterns? Regardless of the type of firms that use credit guarantee, we have some frameworks, general frameworks for designing and analyzing credit guarantee schemes and systems. For example, we can talk about ownership structure, different ownership structures like public funds, private funds, a joint public-private ownership, and special case of mutual institution consist of, for example, banks, or consist of firms itself, which come together and forms a credit guarantee fund. Or another patterns takes place in execution framework. For example, which guarantee services are provided: loan guarantees, equity guarantees, or contract-based guarantees, or liability distinction patterns. Do we have only direct guarantees, or there's still there's also counter guarantees for the guaranteeing, and a third party come to the guaranteeing process to have some responsibilities of guarantees as a insurance. Or for example, in execution framework, we also have guarantee provision and inclusion scope. When we talk about inclusion scope, we have open schemes regardless of type of firms, and we have closed and targeted schemes, which target, for example, special kind of firms, for example, in IT sector, and so on. And when we talk about guarantee provision, we talk about how guaranteeing happen. Is a guaranteeing happen one by one, individual guarantee, or we have a portfolio guarantee, and there is a portfolio relationship and long-term relationship between guarantee fund and guarantor, for example, and banks. And the final framework that we use to analyze patterns is a legislative and monitoring framework. Consists of governing institution, which public institutions, governing funds, and governing the relationship between credit guarantee funds and other financial institutions, macro laws, supervisioning these funds, and also public support models like public actions in data infrastructure and credit risk assessing infrastructure, or for example, some facilities in tax for these funds. So here I described a general framework for credit guarantee schemes, credit guarantee systems, and our core question, not only for Iran, but for all countries which are developing their credit guarantee system, is that how these general patterns, general frameworks should adapt, should adjust, should fix for their technology-based firms, in their technology ecosystem, in their innovation ecosystem. I hope that I will reflect my results in the full chapter, but as to finish my slides, to finish my presentation, I want to notice some important patterns as an example that we found in Iran in our study. I want to start with limited use of various models in ownership structures like public-private models or mutual institutions, or lack of specialized guarantee funds. In Iran, we don't have funds concentrated only in guarantee services for technology-based firms, and guarantee services are besides other services like, for example, loan and VC, other services, and in financial and economic instabilities or internal instabilities of funds, we can see that the share of guarantee services move across other services of funds. Key patterns in execution framework, I can mention limited use of counter guarantees, portfolio guarantees. I especially concentrate on these two models because counter guarantee can help funds to move across larger services and guarantees, and portfolio guarantees can make a long-term relationship between a lender and guarantor, for example, guarantee funds and banks. And also, we have a higher focus on contract-based guarantees. Let's say a gradual orientation toward contract-based lending, and as a cause, limited access to loan guarantees. Technology-based firms in Iran have limited access to loan guarantees and limited choices of funds for these services, and this is a gradual trend that caused some limitation for loan guarantees and also to some extent equity guarantees.
Dr. Fatemi, the time is over almost.
Okay, I will finish. This is the last slide. For an example of legislative frameworks, I want to concentrate on support mechanisms and mention two limited mechanisms: risk-sharing instruments for private funds and facilitating measures in validation, database, and credit scoring infrastructures. These two measures, these two facilitating measures by government play crucial role in controlling the risk and maybe a reduction or redistribution of the risk in offering credit guarantee services for technology-based firms. Okay, thanks a lot for your kind attention. I will be very happy to hear from you and from your comments. Thank you.
Thank you very much, Mr. Fatemi, for the presentation. It's an interesting chapter. So Professor Yoshino, are you available in the session?
Can you hear me? Okay. So I have comments for each paper. Thank you. First one is Lan Yugen's paper and Sagara-san's paper. In my speech, I was talking about two kinds of SMEs. For example, after COVID-19, one is temporary some problem. So then that will come back. And another one is structural problem. So it will keep on declining. From your transactions data, would it be possible to identify one recovering group or structural problem? So in other words, if we look at the data, transactions data, if their sales are already diminishing before the, for example, COVID-19, and then after the COVID-19, their sales will be keep on declining, that is a structural problem. And another one is temporary problem is previously there's no problem, but after the COVID-19, their sales has been declined or their profits has been declined. So my question is, those kind of differentiation, would it be possible from your cash flow data? That's point. And second one is padded paper. It is very good and well summarized. And my question is, credit assessment in Thailand, what is the time lag? Is it a 1 month or 1 week or 6 months? In case, for example, in Japan, banking data delays 6 months. So it's very long. But another data are very quick. So I'd like to know the time lag of the credit assessment of NCB's data. And last paper about credit guarantee system, it is always the moral hazard problem because that small businesses often would like to receive their credit from banks. So the banks will go to Credit Guarantee Corporation, then defaults and losses will be created in CGS. So I'd like to know the profit and loss statement of CGS in Iran and balance sheet. Whether are they accumulating losses for many years or do they have a good balanced budget? So if they have a balanced budget and good healthy condition, why is it possible to avoid moral hazard problem? And if there is accumulation of deficits, then you have to have improvement to avoid creating moral hazard problem. So those are my comments for 3 presentations. Thank you very much.
Thank you very much, Professor Yoshino, for excellent comments on the papers. So I also have some comments. So on the first presentation by Dr. Heydari, so it is interesting, just since we have other chapters on Iran, in order to avoid overlapping. So please just focus on matchmaking companies. So no need to talk about the startup ecosystem in Iran and financing system because other chapters are talking about it. In addition to that, since we have, other chapters on Iran, please not limited only to Iran, study other countries. It is okay that your qualitative study is using Iranian sample, it is okay. But study the matchmakers in other countries like this, so that the chapter is not limited to Iran. So this is one thing. Secondly, the mentoring role of matchmakers is very important that you mentioned. Please highlight it. So in Japan also, the mentoring role in some cases is by the government. For example, the SME agency of METI or even JFC in some cases provide some advisory services to startups. So please focus on this matter and study other countries' cases. Regarding the final chapter by Dr. Fatemi, again, same comment. please not limit it to Iran. Study other countries, different countries, cases of role of credit guarantee in making the lending to startups, especially tech-based startups, easier. And since we are talking about startups do not have background, so how to assess the risk, this is important. And this is in line with Professor Yoshino's comment, in order to avoid the bad assets or the default for the credit guarantee corporations. So if the panelist wants to answer or any comment wants to raise, please.
Yes, Professor Yoshino, thank you very much for your comment. So to identify structural problem company from temporary problem company, so your definition is that the sales of these structural problem company before COVID is already on declining trend, and for the temporary problem companies, the sales would be good before COVID.
Sales or cash inflow, cash flow may be very good, okay? But after the COVID-19 suddenly dropped.
Okay.
And another one is even before the COVID-19, cash flow may have some problem, and it continues.
It continues to be problem. So that's still, so you want to know if our cash model, a transaction model, could be able to tell the difference, to predict which SMEs is a structural problem or temporal problem.
Yeah.
Thank you very much for the comment. For this book chapter per se, I think it would be, since it's already August, to submit the book chapter, I think it's a bit difficult to apply your idea. However, we think that I think that it would be interesting idea to explore for a different paper.
Yes.
So let us think upon this. I think it has a potential, since we do have before and after COVID data.
Yeah, okay.
Thank you very much.
Thank you, Dr. Ngoyan. Mr. Fadet, do you want to?
Okay, yes. Yeah, thank you very much, Professor Yoshino, for your questions. So just want to clarify to you about, do you want to know what is the lagging time in the processing?
Yeah, in data collection, yes.
Right, in the data collection?
Yeah, some data may be very quickly known. Some data has some time lag.
Okay, so let me explain from this picture. I think normally our data collection is on a monthly basis.
Monthly, I see.
Yeah, monthly basis, because once at the end of the month, the member has the 20 days to process the data and submit to us. So it's been that it's not the real time, it's 1 month behind. It's 1 month behind.
I see.
For, let's say, for example, this is the July month, right? So the latest data that they can see is going to be the June month.
I see.
It's around 45 days of lagging times.
Right.
And
do you have your own within NCB? Do you have their analytical section?
Yeah, we do. In this slide, you can see this slide. We have two types. One we call the credit information. This one we have the limited of the period to be collect only 3 years. All right. But this one we have unlimited of the year to collect. But this one is anonymous database, or we call the statistic information. But this is not openly for the public, right? But because there is the law just implement before we if you remember, we have joint research together, right?
Yes.
But at that time, there is no law to be regulated on the statistic information. But right now, they have the specific rules of the using this statistic information. So for example, if the government, they want to use the information, or the Bank of Thailand, they want to use this kind of statistic information, is this to be only one objective for the financial stability study or historical financial stability study? It is not for making some revenue, but it's for the educations. So this is the limited of the objective using statistic information.
Okay, thank you very much. Very clear.
Okay, thank you.
So, Dr. Haydari, do you have any comment to add? And
no, I just wanted to thank you for your comment, and it would be done in the final chapter that would be sent to you.
thank you very much. And Mr. Fatemi, do you have any response to Professor Yoshino's comment question?
Professor Yoshino, thanks a lot for your comment. About the balance sheet, about the relationship between income and expenses of credit guarantee, we have different behaviors between government funds and non-government funds. In some government funds, we have an unbalanced sheet for credit guarantee, and for this reason, in some cases, government will have to rebuild the capital of these funds and help these funds to with the risk and the guarantees which didn't have the expected income. But in non-government funds, especially research and technology funds, the balance sheet is better, and they have limited failed guarantees, and they can control the pressure of guarantees to their capital. But unless one case is in past few years that had a failure because of guarantees to a special company, but other non-government guarantee funds were good in their balance sheet.
Okay, thank you very much.
Thank you. Thank you.
Yes, thank you very much. Okay, so if there is no more comment, question, let's finish this session and move to the final session. Professor Yoshino, thank you very much for your comments, and panelists, presenters, thank you very much for your presentations. The final session of this, do you have anything to add, Dr. Haydari? No. Okay. So the final session of this webinar is the second part of innovations in institutions, product and processes, best practices and policies. We are going to have 4 presentations here. And the first presentation is on the role of capital market in enhancing the startup finance by Dr. Parisa Taghizadeh. I think she's not available here. Let's move to the second presentation. The second presentation is by Dr. Darish David, Financial Innovations and Fintech Solution for Migrant Worker in the MENA region. Dr. Darish David from SIM Global Education, Singapore. Dr. David, please.
Thank you, Professor. Just give me a second. I'm just opening up my slides.
Okay.
Yeah, I hope you can see it now. Thank you.
Yes, it's.
All right. Yeah, so our topic is on financial innovations and fintech solutions for migrant workers in the MENA region. Just to give you a quick snapshot of why the research and the scope of the study, we have identified this region and section essentially because financial inclusion. I mean, there's a lot of literature that covers this, saying that financial inclusion, having access to it, to services from a bank or financial organization is crucial. To obviously, I mean, there are many reasons, but I just picked up a few: escaping poverty, improving the quality of life, allowing people to invest in their future, safeguarding against emergencies and losses in income, and access to credit while avoiding being, prey to predatory lending. So obviously this is really crucial, but we kind of identified a section of population which is even more has issues to getting into to getting that financial inclusion. So why we chose Middle East and Africa is because this region leads with 50% of its population being financially excluded. So globally, that's about 21%. So 1.6 billion people are underbanked or unbanked. So this is quite crucial. So we realized that the Middle East and Africa especially have this issue, and then fintechs therefore have a great opportunity in terms of providing solutions. So West Asia and North Africa, especially Arab states, are also the main destination for migrant workers. So that helped us kind of narrow down to the migrant worker population, which is quite the largest, one of the largest in the world as well. So migrants in the 6 Gulf Cooperation countries account for 10% of migrants globally. Saudi is 3rd and UAE is 5th. The total number of migrants as of 2019 is 35 million in these countries. So this is just to give you a quick look at the data. So we can see that apart from, on the top part of the chart, the table, you can see that apart from Australia and New Zealand and Europe and North America, the highest, in terms of international migrant stock, as a percent of total population, like native population, is highest in Northern Africa and Western Africa. So among developing regions, it's the highest. The bottom part of the chart will kind of show you a breakdown of the countries. So here we have UAE at the top, where 88% is actually foreign, migrant stock. Qatar after that, and the top 4 are Kuwait and Bahrain. But in terms of number, actually Saudi Arabia is also there, so it's the largest. So we want to particularly focus on these 5 countries in our study. So in terms of financial inclusion through traditional banking service is on the decline, mainly because expanded access to digital solutions and services is on the increase. So fintechs can really ramp this up by providing an opportunity for financial inclusion by providing consumers or customers with APIs and streamlining processes to reduce costs and meet regulations. Obviously, this is being done in the banking sector as well as in the non-banking sector, fintechs basically. So, but the trends that are happening right now in the Middle East is that it has large number of migrants, high unemployment, lack of financial literacy, building a credit score which is lacking, and a kind of nascent financial system. So these are a few trends that are happening. So if you see on the graph chart on the left, Saudi Arabia has the largest number of migrant workers. So in terms of fintech landscape for migrants and refugees, just looking at it in terms of numbers in the region, it's not a big surprise that obviously Israel has the largest number of startups, 6,000 plus, and fintechs is quite a large number of fintechs, so about 1/7 or so, so 750 plus. The UAE and Saudi follow. UAE seems to be the next hub for startups and fintechs. And fintechs, as you can see, is over 400. The rest of the countries have less startups. The interesting thing here is among the more developing countries at the bottom, Jordan seems to have a lot of fintechs as well. So that was quite surprising. Fintechs for migrants and refugees is quite a specialized thing. So remittances are important for countries that receive them, so as they play a large part in countries' GDP. So the moment you talk about migrants, the whole concept of remittances come there. So that's a huge opportunity for fintechs. So here I think the most of the innovation is happening even in the MENA region, where payments, with no surprise, transfers and remittances are about 85% of the entire fintech companies. So remittances happen to have a large role there in terms of solutions. So and Middle East is also the home to some of the world's largest percentage of expats and immigrant workers, which I already mentioned. With regards to policy like challenges and scaling, which I think we want to kind of identify in our work, is to kind of look at, say, mainland versus free zone governance because of countries like UAE. which are more open, so it's more easy for investors to come in, while other countries it's more difficult to get that capital for startup investments. Then companies looking to expand beyond GCC would need licenses and things like that. So the regulatory environment is quite tough. But there are I think initiatives in the region for setting up regulatory sandboxes, so which help kind of test these ideas and startup solutions. So RegTech is also growing. RegTech, especially in say data distribution, especially through big data, and identify you know, like eKYCs and things like that, which were already mentioned you know, in earlier presentations. So the importance there are also being tested here. Access to startup finance is still early stage ventures. Are the main ones investing here, and also maybe, you know, like World Bank funds and things more like multilateral development banks are investing here, mainly because migrants and refugees do not fit into impact investors. Forgive me, I kind of suddenly brought in refugees. The point here is that we're also looking at, so the migrants are more on the economic sense. So we also wanted to have a small case study within our chapter, if possible, of refugees, because I think that there is a huge number of refugees as well in the region. So we thought that, and the solutions are different, and refugees who are more have issues more in the political sense do not have a choice of going back, while migrants actually will go back, right, to their country of origin. So we wanted to differentiate that as well in terms of this, the needs that or the solutions that are being developed. So there's a lack of talent and lack of direct and indirect initiatives such as accelerator programs. Although a few of these countries do have you know, startup hubs and fintech kind of hubs. So we will highlight them, you know, including Bahrain and Dubai and things like that. Then the fintech solutions are specific to migrants and refugees, are mainly specific to solutions like, you know, identity documents, so eKYC, high international transfer fees, so transaction fees, foreign exchange you know, solutions there, carrying cash savings when forced to flee, especially for refugees. Internet access and access to smartphones is a huge issue, because only if they have access to that, they can conduct these transactions, which might be low. Bad exchange rates and expensive P2P services, because these are still technologies that are quite expensive. So these need to be scaled. So that's one of the major challenges that I think we want to look into. So we've identified 4 major fintechs here that we want to kind of use as case studies, and then we want to look at the technologies that are being used. So if you see, most of these are quite recent. Some are based in the region, some are not. Leaf, for example, is based in the US. So most of them are the technologies are distributed ledger technologies, so mostly blockchain, digital banking, and similar technologies. And then in terms of features of the products, there are also cross-border payments, mobile wallets. So these are kind of solutions that are being developed for this population subgroup. So just to give, I'm coming to the end of the presentation. So just on the left is we want to kind of, I know it's too difficult to go into each of these countries. They all have quite developed ecosystems or developing fast ecosystems for fintechs. So we want to kind of just highlight what have been the strengths of certain, whichever countries have been successful. We want to see what has been the success behind the development of fintech ecosystems in terms of you know, the support they get from government, fintech startups, traditional financial institutions like banks, you know, like investments from there, technology developers, and the customers themselves. On the right, I actually we're trying to find the business model for these companies that we mentioned in the previous slide. But for now, I've just included a kind of potential, you know, a business model that we want to find based on the case studies that we use to show us how the entire system works for migrant workers. So how you know, the cloud services are. So on the right, this is actually a real life case study of a company called Palo, which is based in Malaysia, and they provide solutions for migrant workers from Myanmar. So we want to find something of this sort, this kind of case study that we can kind of show in the book chapter on the Middle East and how they are providing solutions in terms, one on the top of on the right, you see the whole ecosystem in terms of what are the main technologies being used, and in terms of on the bottom saying what are the basic solutions being provided to make it easy for migrants to actually access this finance and make these transactions, especially say cross-border remittances. So I'll end with the expected policy implications. So it'll obviously provide more policy and regulatory, literature, enriching that and providing financing case studies that are doing more work on the social good or social sustainability aspects by empowering the underdeserved populations such as migrants and refugees to access basic financial services. It will look at all the fintech experiences. So how are these fintechs developing solutions? Are they being able to scale? What are the issues with costs and the technologies as well? So authentication, blockchain, analytics, P2P, crowdfunding, AI that are being used within these companies, and then look at successful ecosystems that are conducive to new financial alternatives. So just the fact that this new technologies and and fintechs are able to kind of tap onto these underserved populations, looking at how this will really help improve financial inclusion for migrant workers and hopefully a little bit on the refugee side in the Middle East. So I'll stop here, and I'll be happy to take your questions later. Thank you.
Thank you very much, Dr. David. It is very interesting chapter. Thank you for your presentation and contribution to the book. So Dr. Taghizadeh is with us. So I'm going to invite her to present the chapter. The chapter is on a role of capital market in enhancing the startup finance. Dr. Taghizadeh is from National Research Institute for Science Policy of Iran. Dr. Taghizadeh, please.
Thank you very much. Sorry for electricity cutoff that I disconnected from the webinar. Thank you for joining me to this webinar. It's a pleasure to present my slide. Let me share my screen. Is it okay? And yes. My voice, and is it okay? Okay. This chapter is about the role of capital market in enhancing the startup finance. I try to present very quickly because I am worried about my battery and other problem that may be suddenly happened. As you know, most SMEs, especially in developing countries like Iran, have been suffering poor access to finance. Small businesses and startups in particular are often under-collateralized and have limited credit history. Also, investing in firms engaged in innovation activities is associated with higher information asymmetries that is between firm and new technology-based firms and startups is gradually increasing with an expanding share in job creation and sustainable growth. In Iran, we have also this expansion. What are the potential of capital market financing for SMEs and startups? This potential, first, exchange market via exchange market, and the second potential could be via organized over-the-counter market or OTC. However, policymakers in most developing countries had not considered the development of SME capital markets. There are some reasons for this failure. First of all, is related to bank-centered financial systems in developing countries. And moreover, underdeveloped innovative institutional arrangements that many developing countries suffer from this failure. And the third reason is a limited demands on SMEs and investors for capital market financing. And the last but not the least reason is less coordination among multiple policymakers responsible for the startup and SMEs sector development and finance. That this reason is very significant, is very clear and very important, especially in Iran. But the opportunities and limitations of markets for SMEs is that equity financing is the process could be realized types of mechanism. First of all, equip company activities by selling common stock investors. The second mechanism is growing in Iran is venture, which is one form of equity financing used to fund high risk, promising operating companies, often high technology firms. At now, we have more than 5 VC fund in OTC market that we will study more precise in this chapter in the future. Private equity or PE is an asset class providing finance to invest in turnaround companies and leverage buyouts, VC, and private equity. PE in Iran also is growing as becoming more comprising. What policy implications could be extracted at the end of this chapter? Some of the most important ones that I presented here is, as you can see, government can help SMEs secure capital market financing in several ways. SMEs with various degrees of risk exposure could be pulled together and basket to lower credit risk and be more attractive to debt market, for example. Government should also try to construct a favorable environment from entry to exit for VC capital investment, for VC investment. Various exit channels are required for this purpose. Government should use private resources efficiently, for example, through public fund of funds. This mechanism is also growing in Iran. If a government invests in SMEs directly, there may be moral hazard because SMEs know the government cannot withdraw their support for political reasons. However, private investors have more expertise in constantly changing and developing financial projects. So fund of funds is an interesting mechanism. Our methodology for this chapter is mainly based on desk research and also semi-structured interviews with the capital market experts and startup founders. In last slide, I present detailed table of contents of this chapter. First, the obstacles of conventional financing will be discussed. It's about approximately about 20% of the chapter. And then we review capital market solutions for financing SMEs and startups, both in developed and developing countries. It's about 30% of the chapter. And then we focus on Iran, startup financing through the capital market, and we review the Iranian experience in depth. It's about 30% of the chapter. And finally, By comparing the past two sections, we try to extract exact policy recommendations for both developing and developed countries, but with more focus on developing countries. Sorry if I was very quick, and I am ready to have your comments.
Thank you very much, Dr. Alizadeh, for your presentation. So let's move to the third presentation. So we will have comments on the papers after these two presentations. So the third presentation of this session is by Dr. Ghazi Salahuddin, Associate Professor at Linköping University in Sweden. Dr. Ghazi, please.
Thank you very much, Farhad, giving me the opportunity to present our paper. So I try to share this paper in a short and very precise as much as I can. So the topic today I would like to discuss about the complex network in fintech market under uncertainty. The project is in collaboration with Professor Shiraz at Örebro University, Eva at Dublin, and also the Dr. Bisma at Linköping University. So what I try to explaining in this paper is basically that what type of uncertainty are particularly triggered to the fintech market, or the answer or fintech can also be triggered to the uncertainty market or not. So if you look at the basic fundamental stylized fact of the global fintech industry, you get an idea that global fintech revenue were about 92 billion USD in 2018 and are expected to be 188 billion in 2024 based on it was actually based on pre-COVID-19 forecast, with the digital payment accounting for 80%. And also APAC and American region also is found for 40%, while the emerging market region is around for 20% of the global market share. And if you clearly observe it, that based on the stocks global fintech index and MSCI world financial index, you get an idea that how these index are changes over the period of time between September 2018 to 2020, except that during the COVID period of time has a sharp decline, and then it is started to again to raise. In my next slide, I would like to share that how the investment pattern of the global real activity in fintech in terms of the amount of capital is invested. Also, you can get an idea the major leading country who are contributed in the global fintech market, which is led by which is the countries such as like UK, Germany, Spain, France, Switzerland, Netherlands, and others. And the sector, if you look about the global fintech sector, is most likely to the alternative lending, personal financing, insurance brokerage, financial planning, financial advisory, crypto market, distributed of the larger ledger technology, and AI and analytic, and etc. So these are the, and also the crowdfunding is also another important component under the fintech market. So what I try to explaining like in this study, that as the fintech industry or digitalization are actually playing a very important role, not only for the developed countries, also for the developing market, as well as it is one of the very important component for the financial service sector. And due to the exponential growth of digitalization, and also these are the process are very strongly connected through the globalization process, the adaptation of fintech has been increasingly embedded in our everyday economic transaction, and which has forced to financial institutions to clarify their strategy, develop new capability and strategic collaboration, and transform their culture from their legacy and the traditional system. However, these dynamics also become created the complexity of everyday life when it connected to the financial and geopolitical institution. So in that context, it is very important to understand how the causal relationship between financial and geopolitical uncertainty shock on the fintech industry, because it is an important important policy related questions which could be important for the regulators, policymaker, and academician. And in this context, we also look about the different literature review and look at the previous study. That previous study are mostly focused on the fintech firm often conform to the traditional firms by regulatory environment that cannot keep up with the speed of technological change. Like these barriers or challenges can cause the obstacle to innovation and disrupt public interest. And also, given the volatility nature of the fintech industry, it is and its increasing impact on the real economy, it is important to develop a clear understanding of the dynamic influence of fintech industry from the perspective of capital market. And also, these dynamic technological issues, despite the significant research of understanding the linkage between fintech and financial institution, its impact towards the financial and geopolitical uncertainty is remained unexplored. So that's why the aim of this study we are interested to looking for the directionality and connectedness between the financial and geopolitical uncertainty on fintech market. In order to address this question, we consider the non-linear causal relationship between fintech and the several uncertainty indexes by utilizing the convergent cross-mapping framework proposed by Sugihara 2012, and look at the directionality among the underlying series. And the issue of non-linearity is important to look at the dependence and directionality structure, because the uncertainty are most likely is a non-linear fashion. So that's why that probably the causal relationship could be providing the misleading inference. So in order to get the consistency and inference, we consider to the non-linear based specification. So what type of variable we consider in our investigation? We consider the volatility index. This volatility index measured by implied volatility of S&P 500 in 500 options index, and these are the index computed by the Black and Scholes formula. And also we're looking at the 100 oil market ETF based crude oil volatility index, which is represented by OVX. And these are the two concepts, like VIX is representation for the financial market uncertainty, and OVX is representation of the geopolitical uncertainty. And our analytical framework is fundamentally based on nonlinear state-based construction of the directionality approach. And we evaluate the reaction of fintech to financial and geopolitical shock by utilizing this nonlinear dynamic causality approach. And lag order is provide the highest predictive ability in terms of the best embedding dimension, that it utilize the convergent cross-mapping networking process. What are our key findings? Our key findings is the causal relationship between fintech and VIX are significantly higher flow of causality from VIX to fintech. So it means that financial market uncertainty triggered to the fintech industry, and also increase in nonlinear causality from fintech sector to the financial market uncertainty. However, our finding indicated that unidirectional causality from geopolitical uncertainty to the fintech, indicating that lack of integration from the geopolitical perspective. And a new market offered the financial tools for new populations. So fintech often operate spaces where regulators' guidance are limited, thus perhaps explaining the lack of causality from fintech industry to the geopolitical industry. So what are the practical contribution based on this finding? So our finding has important implication of the capital market participant and the stakeholder. Number one, investor must consider the fintech industries with the financial sector, while the risk transmission to the geopolitical sector is minimum, probably due to the innate technology focus on the financial sector. Second one, the fintech sector can be viewed as a net receiver of geopolitical uncertainty, an important aspect when diversing the investment strategy during the time of stress on the geopolitical turmoil. And the policymaker and regulator need ensure that fintech sector rebalance their product and services by including the non-financial business and institution in their target market. And finally, the regulatory authority need to be careful to balance the efficiency and stability trade-off to ensure that the risks and stability and the integrity can be effectively managed without stifling the innovation. So that's so far the short presentation of this chapter. Thank you very much for giving me the opportunity to present of our paper.
Thank you very much, Dr. Ghazi, for the excellent presentation. It's very interesting chapter. I appreciate it. So the next and final presentation of this webinar is by Dr. Subramanian. So Dr. Subramanian is a senior advisor and independent consultant from India, and his presentation is on the impact of COVID-19 pandemic on innovative fintech in India. Dr. Subramanian, thank you very much for joining, and we are waiting for you. Please share your screen.
Thank you very much, Dr. Farhad. Can you all hear me?
Yes, it's clear.
Hello, everyone. Greetings to all from India. At the outset, I would like to thank the organizers, Tokai University, Iran National Fund, Technology Studies Institute, and Routledge, especially to the editors, Dr. Farhad, Professor Yoshino-san, and Dr. Abu-Jafari, for giving me an opportunity to present my last paper for the session today on the impact of COVID-19 on innovative fintech in India. Being the last paper of today's session, I'm sure that you must have heard a lot of information about innovative finance. You are flooded with information. I'm sure that you would have some little space to hear or to listen to me. Let me share my presentation. In India, innovative financial technology has emerged. Can you all see my screen?
No, we cannot see.
You cannot see?
Share it.
Hello?
No, we cannot see.
Oh.
Dr. Subramanian, I can share on behalf of you.
No, I can even.
You can do it.
I think I have to. Hello?
Yes.
Is it okay now?
No.
Not yet.
So I can do it. It is okay. And then you say I go forward.
Oh, okay.
Just a moment. Yes. Please start.
Yep.
I already shared. Yes.
Oh, I can, okay.
You just speak, please.
Yeah. In India, the innovative financial technology has emerged as a major disruptor in financial framework, challenging traditional financial services. Innovative finance is a viable option due to rising bad loans in India. In financial institutions, customer dissatisfaction is prevalent in India for traditional products and services. The Indian financial industry can discover financial innovation in terms of institutional innovation, products, and processes innovation. In India, many startups and small businesses are experiencing several financial challenges due to lack of credit and inability to get financing. At the same time, India is witnessing a boom in digital innovative fintechs. It has eased the financing processes and accelerated the growth potential significantly. Fintech is currently facing one of the biggest challenges, namely the COVID-19. It holds the key to unlock safer and more secure financial inclusion. Under the current pandemic new normal situation, Fintech can explore greater opportunities and provide robust digital financial services. Currently, innovative financing have caught the interest of financial institutions and institutional investors in India. It is a crucial instrument that policymakers can use to lead India through the challenging situation. This chapter attempts to examine the impact of COVID-19 on innovative fintech in India. In meeting this objective, the study looks back at the emergence, growth, and development of innovative fintech in India. This qualitative study intends to analyze the effect of the prevailing and post-COVID-19 situation on the prospects of the fintech industry in India. The methodology adopted is basically descriptive. It is based on a comprehensive review of literature. The chapter highlights some of the key areas and the recent research trends and draws on authors' professional expertise in the field. The study's policy suggestions will provide policymakers, researchers, economists, and financial experts with a better understanding of future prospects of innovative finance and fintech in India. Basically, the chapter is classified into four sections, namely the first one being the overview or introduction, and then we talk about the pre-COVID-19 phase, and then during the COVID-19 phase, and then finally the post-COVID-19 phase, with ending with conclusions and recommendations. Under the pre-COVID-19 phase, during 2015-20, there has been an unusual growth in the fintech adoption rate, investments, and startups in India. Fintech was slowly growing and reaching a remarkable level of compared to most of the world's fintechs. As of March 2020, that is when the start of the COVID-19 had the highest adoption rate of fintech. There is 87% adoption rate was noticed among all the emerging markets in the world. On the other hand, the global adoption rate stood at 64%. This is according to PwC. Increased fintech penetration and adoption across all industries have a positive impact on the Indian economy. During this pre-COVID phase, fintech has seen significant growth in transforming the financial sector in India. According to KPMG, the fintech is transforming to a powerful ecosystem that provides startup platform to grow into $1 billion unicorn. Fintech in India has garnered more investment as the number of firms, fintech firms grow. This chart shows the fintech adoption index in India under different categories, namely the money transfer and payments, financial planning, savings and investments, borrowing, and insurance. Moving on to another chart, fintech investments in India, again, based on the different categories like payment, remittances, marketplace lending, wealth tech, real estate, infrastructure and enterprise, etc. So here again, most of the fintechs in India is under the category of payment and remittances, which is shown in this chart. The growth of online digital transactions enabled transparent, secure, fast, and cost-effective methods benefiting businesses and consumers in India. Fintechs have diversified into different areas. Also, payment and lending is replaced by wealth, brokerage, insurance, and multi-sectoral companies. Digital finance-related initiatives of the government had a significant impact on the growth of fintech as well as financial inclusion in India. According to CB Insights Fintech survey, India has reached the 3rd rank in the global list of the 250 most promising fintech firms. During the pre-COVID phase, the fintech industry in India was on the verge of the highest growth. However, the unpredictable crisis of COVID-19 at the start of 2020 has completely shaken the industries, including the fintechs in India. Now, moving on to the during the COVID-19 phase, due to lockdown and mandatory requirement of social distance, etc., online transactions had grown up significantly to 80% as compared to 2019. This is very much obvious. Recognizing the uncertainty created by COVID-19, fintechs have to face pressure on many fronts. Fundraising has been difficult for early stage businesses as investors focus on fintechs established clear business models. In terms of consumer credit, urban dwellers got fintech loan services to avoid heavy paperwork during the COVID-19 scenario, and rural people also got benefited. As most revenues is based on transaction value and volume, the important strategy during COVID-19 is to ensure minimizing fixed and variable costs. A study of 250 Indian startups confirmed the pandemic had a negative effect, although fintechs reported low performance disruptions, as according to FIXI in India. This chart shows the top 250 fintech firms in 2020 globally, wherein USA stands first with near about 130 plus fintechs, and UK stands next, and the 3rd rank is coming to India, which is very, very significant as far as India is concerned. This chart shows the fintech startups as of 2020, again categorized like payment and remittance, marketplace lending, wealth tech, personal finance management, insurtech, etc. During the COVID-19 phase, in response to the public health crisis and positive recovery, fintechs reduced the impact of COVID-19 by resetting their business models, taking advantage of the opportunities created by the COVID-19. This translated into a cost reduction of 15 to 20%, converting performance to semi and full remote and transforming product roadmap either by closing sectors, delaying product launch, or introducing new products in fintech. Many fintechs received funds and investments from investors and lenders. Others used cost-effective methods such as staff downsizing. Overall, fintech in India remains optimistic and confident for a long period of time, with most fintechs expecting a full recovery by 2021 and 22. Under the post-COVID phase situation, it is more a recovery phase from the new and from new to back to old normal. Fintech growth is expected to continue by embracing new opportunities from COVID-19 and by using its unique assets and capabilities. COVID-19 has transformed the fintech in India. It has been a prominent sector during and beyond both business and investment opportunities. However, as the COVID-19 pandemic is still not completely disappeared and it is still prevalent in India, with the uncertainty that exists, a cautious approach is essential. In the post-COVID-19 phase, the situation is expected to endure beyond the pandemic as the internet users discover new ways of behaving, best innovative practices, and adapt the new normal in the digital age. Fintech is benefiting all customers and likely to continue post-COVID-19 situation. This chart shows all the three phases, that is pre-COVID, during COVID, and post-COVID, the pace of fintech growth in India. As you can see that pre-COVID-19 is more of a measured pace of growth, and during COVID-19 it is accelerated growth, and it is expected that the post-COVID will mostly show a sustained pace of growth. In response to the, I think this I have completed. Yeah, in post-COVID-19 phase, business models are reevaluated to introduce and implement new innovative techniques and remote capabilities. Fintechs have shown resilience, giving hope for surviving such a crisis. They have taken steps to reduce vulnerability and reduce costs, including reduced staff. It is a sign of better prospects under the post-COVID-19 phase. The post-COVID-19 in India will be different from pre-COVID-19 phase, obviously. It will be proud to have a new system while helping people after the lockdown. The post-COVID-19 is likely to be more closely linked to digital life, obviously. Fintech could grow stronger by refocusing on innovation and better principles and practices. This will build opportunities for strategic investors along the way if they can react quickly to the demand. The conclusion and policy recommendations. The goal of innovative finance, obviously, is to use digital innovation technology to offer efficient and effective financial services to many businesses and individuals, not only in India, all over the world. The policies and constraints such as lack of finance are major challenges even in India. Amidst prevailing challenges of startups and small business financing, fintechs in India can use their unique assets and skill to build new opportunities. The policy certainty, government support, and lowering the financing cost could be considered as possible solutions for overcoming the challenges. Fintech innovations have the ability to transform and reorient India's ailing financial framework. Developers and market stakeholders believe to formulate cohesive and meaningful policies based on their support. However, policy implementation is a major challenge in India. Also, it is necessary to maintain a stable policy environment to attract investments to India. The fintech in India must take concerted efforts to provide startup entrepreneurs with a solid foundation and an access to investment so that they have the opportunity to enter and grow through these difficult times. Technologies such as distributed ledger, blockchain, and smart contract technology enable the tracking and direct transfer of digital assets without the need for trusted intermediaries and which will significantly lower the cost. Reduced cost of issuing bonds and other securities can make it easier for the startups to get funding, as it is now only accessible only to larger issuers. Innovative fintech is a crucial instrument that policymakers can use to lead India through the various challenges. A concerted efforts to expand and enhance the innovative finance will greatly boost and contribute to developing a robust, egalitarian, and more sustainable economy. So that's the end of my presentation.
Thank you very much, Dr. Subramanian, for your presentation on the situation of fintech and most recent development in India. I appreciate it. So with this, we reach to the end of today's webinar. Just let me have some comments on the presentations in this session. So we have four interesting presentations. Dr. David, the presentation was interesting, how to utilize fintech and financial technologies in order to reduce the remittance cost. So remittances, especially in migrant sending countries, is an important part of GDP even. So let me introduce you. I just shared a link in the chat box. So we just published a book on poverty reduction for inclusive sustainable growth. So in this book, chapter 6 is on remittance, poverty reduction, and inclusive growth in resource poor economy. So this is interesting chapter. And the chapter 7 is so much close to your work, utilizing blockchain technology in international remittance for poverty reduction. So I invite you to read these chapters and please use in your study. And so this is my comment. In addition to that, that case study of that Malaysian company is interesting. If you can talk more in your chapter about that Malaysian case, would be interesting. Next, Dr. Taghizadeh's presentation was also interesting. So as I have mentioned in my previous comments on the Iranian presentations, please not limit your study to Iran. So it is okay that your empirical study is using the Iranian data, but the chapter shouldn't be just limited to Iran, as we have other chapters on Iran. So try to study other countries that developed a capital market, stock market for SMEs. In East Asia, we have China, the largest SME capital market, Hong Kong, Taiwan, Thailand. So these cases are available. But generally speaking, why capital market is not a main source for funding SMEs, even in these countries? So this should be answered in this chapter. And this is the first question. Secondly, what are the requirements for developing the tech capital market or SME capital market? And what are the prerequisites to be listed there? So it means instead of just defining the issue and situation, talking about the requirements, what are the reasons behind the unsuccessfulness of this market for bringing funding for SMEs, and why still banks are the main source of funding in most countries, including in Iran and in many other developing countries. Regarding Dr. Ghazi's chapter, the chapter is very interesting. I don't have any specific comment, just since this is a paper for a book, so please simplify the technical statements and make it a little bit more policy oriented, as the readers are more general, policymakers, researchers from different backgrounds. Thank you very much. And Dr. Subramanian's chapter is also interesting. Just in your chapter, please answer that. Please answer to this question that although most recently there are lots of good progress, technological progress in India, we observe many new technologies, and in the financial sector also there are lots of good technologies, financial technologies and so on. But why financial inclusion is still the matter? Why financing is still the matter? What are the obstacles? So it means the chapter, although it should provide an overview of the current situation, but it need to solve something. It need to find the problem, and the policy recommendations also need to come from the chapter. So it should be more related to the study. So this problem solving aspect of the chapter should be highlighted. It's good that, for example, 30%, 40% of the chapter talking about the current situation, good progress, development, and so on. But after that, defining the issue, finding the problem, and trying to solve it in that study to be useful for India and also for other countries. So if there is any comments by the presenters, any point that you want to mention?
Thank you for the comments, Dr. Farhad. I'll incorporate the two books. I saw the links, so definitely we'll look through them and include it in the literature.
Thank you very much. Thank you very much. So, Dr. Subramanian, if everything is okay, clear. Yeah.
Yeah, thank you very much, Dr. Farhad. Your points are very well taken. I will include the various obstacles and why the financial inclusion aspect, and also give solutions for this one, and which will be linked to the policy recommendations as well.
Thank you very much.
And incidentally, I just wanted to ask you one question about the chapters, and about the book. I was just going through the guidelines of the book, and which under which it is mentioned that the literature survey or the review of the literature is not included. Should we keep it as a separate, regardless of your the contents which you have mentioned? No, I'm referring to the guidelines of the guidelines to the author.
Literature
or should I include in the introduction aspect?
So it is not any specific format regarding the review of the literature. Review of the literature can be a part of introduction, or it can be as a separate part.
It can be, correct? Okay, that's what I wanted to clarify.
To review of the literature, or it can be a part of introduction, either.
Okay. Thank you very much.
My pleasure. Okay, so if there is no more comments, since we are almost past the time, about 20 minutes past the time, so let me finish and wrap up this webinar. And by this means, I want to express my thanks to all contributors, presenters, panelists, discussants, participants for spending this whole day and long day webinar and spending your valuable time with us. I hope the comments that we receive help us to revise the paper. So I have already sent the guideline and timeline. Please submit the full paper by end of August. And since we want to have on-time publishing, then after we receive the chapters, we will read it again and we may provide some additional comments for revision. And one more point is to similarity will be checked. This is very important because publishers are so much stressing on it. So before submitting the paper, please check the similarity ratio by yourself. It needs to be less than 20% to be publishable. Okay, thank you very much to everyone, and take care of yourself.
Thank you very much.
Goodbye.
Thank you very much.
Dr. Fahad. Bye-bye.
Thank you.
Thank you, everybody.
Goodbye.
Thank you, Darwish.
Thank you.
Darwish, thank you. How are you? Keeping fine?
Fine, Dr.
Okay.
Thank you.
All the best.
Yeah.
Take care.
Thank you. Bye.
I also thank you, all of the guests.
Thank you, Dr.
Goodbye.
Abu Jafari. Thank you very much.
Thank you. Thank you very much. You're welcome.
Thank you. All the best for you.